listen to affirmation, just do nothing. I feel the biggest power that meditation affirmations have given me is the power to do anything. Is that power to be able to sit and be relaxed without having any
And
expectations.
listen to affirmation, just do not.
So, as we start this master class on money today, I'm super excited because today, not just me, Roshni will be coming at 10:30 to help you all get into the zone of money. But before we get in there, let us quickly take a minute to reflect on our biggest wins this week. Some of the wins, for example, Dr. Judy here has been did her offline event, and she had, I think, 5 people joining in her offline event, and they were sitting till 4 p.m. and discussing. That has been one of the biggest wins. Some other wins is Dr. Rabi. I see she is posting very consistently now, and talking about personal branding. Ever since we have launched it, we have been sharing what is your biggest small or significant win this week. What has been some of your wins that you are really proud of? Of course, please unmute yourself and tell me if you want to. What are some of the wins this week that you are proud of? For example, let me start. One of the biggest things that I'm very happy about is ABHA. So, as you know, right in February, we had the social media boot camp, and ABHA was one of the people who, when she came, she told me that I am very scared of social media. I don't like it. I'm not very fond of it. But if you see her from then, from today and there, you can see she started posting. Look at this, day one, day two, and every day, and I'll tell you the law of compounding, 1% increase, I see her doing better in this. See, it's not easy to be consistent on social media at all. But if you see from day 12, 13, 14, every day she's tried to put on a topic. Now, the topic choosing is not very difficult. All these you can get on Chat GPT, even captions, everything you can get. But the art of putting herself out there, this grit of getting herself, putting herself out there, is what there. And she has covered 28 days now, 29. I think today would be the last day. It's a whole month. So, and in between this, she also got a client from social media. So, my one lesson to all of you today, what I would like to start with it is there कि be as consistent as possible. अगर आपको सोशल मीडिया से डर लगता है, then there are more or more reasons for you to do it every day. Let me show you even Somnath sir's story. When he started with Instagram, the first thing I told him is 1 month of October, every day you post. And that's what he did. Because every time you are posting, it is not only about kaun dekhega, kaun karega, who will see. It is also about the fact that you will learn something. For example, look at Dr. Ravi also. Every day now she's trying to post on her, this is there. See, that I'm starting this, I'm doing this. You need to put it out yourself. That's how you will also grow. Only when you put yourself out there, that's when, it's your personal journey. For example, our own guest today, who is going to be coming here, our founder of Rupee Smart Drive, that's also something she does. Let's take anyone's example, Roopsa's example. Part one, part two. You have to give it some time. You have to give it a little of your effort and do something every day. So here, as you can see, even Rashmi has learned Canva very recently only, but you can see she's trying, she's putting her efforts, and that's why today she is going to come in front of you and talk about money. And also when she started posting about herself here and there, people started giving her opportunities to speak. Yes. So all of you, my general opinion for you all is to start posting. Okay. What about your wins? What about some other wins you've had this week? Nobody had any other wins. Nobody had even win like I journaled, I posted on
Yeah.
Instagram. I was
Yes,
able.
Sanchari. So I have been meditating for last 16 days continuously. One.
Wow,
That is one
yeah.
of my wins, that I was not able to be consistent, but I've been doing that. And the second win is I'm very, very scared of camera. So I have started posting my face videos, though they are not very good right now, but yes, I'm trying.
Where are you sharing on LinkedIn?
Yes, LinkedIn. I put them on Insta also.
I
Insta
haven't seen
also.
on Instagram. I will see. Very nice. Yeah, that's great. Yes,
Yeah. But
that's
I'm not
super.
posting daily right now. थोड़ा सा अभी pace slow हो गया है, but I'll continue. Yeah.
वेरी नाइस। चलो तुम लोगों को थोड़ा मोटिवेट करने के लिए आभा यू टेल मी that this journey that you took, you were so scared of, not scared, you did not like Instagram very much to begin with, and this, how much has this 1 month of consistency, what change has come to you after you started attending and posting? Tell me.
So, hi Sanchari, hello everyone. So, for
Congratulations.
me, to be honest, it was not a fear, it was my thought which was stopping me because of the negative image of the social media. And I think मेरे जैसे बहुत लोग होंगे which actually, जो IITs हैं, IIMs हैं, NITs हैं, they think like what we are doing, posting अपना regular life and all. तो मुझे लगता है कि क्योंकि I see वो मेरा ही thought नहीं है, मेरे husband का भी same thought है. So, but to be honest, Sanchari, like while I posting these things outside, right? Whatever I am doing, अभी तक वो सिर्फ एक, जिनको मैं सिखाती हूँ, करती हूँ, उतने लोगों तक था. But when it, went out, people are जो actually बहुत working हैं, जो बहुत अच्छे अच्छे colleges से हैं, they are earning well, they are actually messaging me, and that's really a proud moment. Like, from last 1 week almost 15 to 20 messages I got it. Like, hey Abha, you're doing great job. Just keep
I saw you
continuing it.
posted also, yeah.
Just keep continuing it. One day you will get it. And मतलब बहुत सारे messages ऐसे आ रहे हैं out of random जिनको मैं जानती भी नहीं हूँ. Like randomly they are telling it to me कि uh, people need it. You just post it. So I can't describe all those things into words, but it just give the happiness. It gives you the push कि ठीक है, you do it. Other than that, uh, uh, the unbelievable things are, I'm seeing changes in myself in terms of कि मैं बहुत conscious थी पहले से ही, but I'm becoming more conscious when I'm talking about it. For my daughter as well. Recently, we went to the party. I don't give my daughter, outside foods and all. I don't give her, and I was surprised how beautifully she was welcoming everyone, and everyone was there. I was the one who was wearing, like you said, na, you look weird outside and people comment on you. It was a western party. I wore suit, my daughter wore full full sleeves frock and all full Indian attire, and everyone there was like playing TV, and they were dancing on, मैं अपने बेबी को टीवी भी नहीं दिखाती, but they were playing dancing and all. मैं अपने बेबी को लेके आई and I was outside कि ठीक है बेबी, you do some physical activities. Just after coming back, my daughter had, मैंने अपनी फ्रेंड से बोला कि just give me wheat flour, मैं उसके लिए एक पराठा बनाऊंगी and I will give her that thing. We'll go to restaurant, don't worry, but just give me wheat flour. तो मैंने वहां पे पराठा बनाया ना, गिव हर, व्हाट, माय डॉटर डिडंट इवन आस्क फॉर कि मुझे फ्रेंच फ्राइज खाना है या ऐसे रेस्टोरेंट में कुछ खाना है. Nothing at all, and it went so smooth. I felt left out little bit just for a 30-second moment. Yeah, what I am doing, everybody, recognizing lots of songs and all those things. I felt little left out. But as I came back, people visited on my profile and they were like, Abha, how come you are doing, how come you are managing all those things? So putting out on the social media, I was literally amazed, the messages I was getting from mothers during the same childhood babies. He Abha, you are doing such an amazing job, and you are working so hard, and we know that how much effort it takes to maintain these kind of things. And not only me, they were appraising my daughter as well. How she was maintaining everything, even if she was also sleeping, she didn't cry and all. So that's her part, but it's all about the while teaching more into the consciousness, I am becoming more conscious. And while putting more content, I am implementing more and more towards me. So this
Not
is
just
the thing.
yourself, in your skills are also increasing. I am sure that the first time you made a post, it would have taken you almost 20 minutes just to figure.
Yeah.
Now I think I see you posting even at 11:30 कि आज मैं सोने से पहले at least I'll finish. So now it takes you
Yes.
probably 3 to 4 minutes to post this and getting out there.
That's true. That's completely true. And to be honest, consistency is something जो मुझे बहुत push किया है. Like even मेरा बहुत hectic day भी होता है after job, home and meetings and all. After that also, I make sure that I have to do it. Doesn't matter how much it costs. So I'm trying. Thanks to you, and because of that,
Great
this
job, Abha, and thank you for sharing this with us. So I can see in the messages, Karishma also said some people have inquired. Dr. Ravi is like, some people are interested. How did they get interested? They will only get interested when you tell them that there is something out there. If you are
yes,
not sharing that you are the what you do with your kids, what you do with your kids, clients, students, and all, they will not know. एंड सम ऑफ यू माइट बी लाइक कि यार मेरे पास तो सिर्फ 400 लोग ही फॉलोअर्स है या मेरे पास तो सिर्फ 100 people फॉलोअर्स है तो आई वांट यू टू टेल यू एंड दिस इज अ गुड थिंग फॉर यू टू विजुअलाइज 400 people look like this. If you had to physically go to 400 people and tell them that, hey, this is what I want to do, this is where I want to go, it will be very difficult. So when you put it out there using social media or on internet, that's when you can reach out to so many people. And a lot of people also tell me nobody sees my posts, only 5 6 people like it. But tum batao, in real life, how many days does it happen when 5 to 6 people are giving you compliments? Very rarely, right? It is very rarely. So even if you are getting 5 to 6 compliments or likes, that's much more than you would get in the physical world. Offline is very difficult. So that's why I'm encouraging you all to, in case you still haven't built your offers yet and you are still not launching. For example, today Jyoti said that I'm coming out of my comfort zone and I'm making videos with my face. Great. Like Dr. Ravi is doing. You guys, there is no other option than this, but you have to put yourself out there. I am going to teach you about sales and marketing next weekend. Niranjan has a very special sales masterclass with you next Sunday. I have a special class with you on next Saturday. So all these in detail you will learn. But the first step of marketing is breaking or getting over your confidence and putting yourself out there. Okay. Tomorrow I have, how many of you were there in my watercolor class? So last Saturday we had done it. Tomorrow at 2 to 6, I have a very fascinating class on sketchnoting. So many of you have asked me, how can I make a journal like this? How can I learn sketchnoting? So tomorrow 2 to 6 p.m. I'm going to teach you another technique of sketchnoting, which in itself will be about helping you to market and do that. Okay, 2 to 6, block your calendars. It's a bonus class. We are launching a new program called the 11-day MBA. Impact Pro, we have bought in changes. So from Monday, we are going to do it. So please join us tomorrow at 2 p.m. for our sketchnote workshop. How many of you will be there? Okay. तो देखो आज तो तुम लोगों ने अपने wins share नहीं किए, but tomorrow I will teach you how to illustrate your wins, how to share in them. So before I call on to Rashmi, let us quickly understand what the wealth framework we have been learning all across March, and we will continue doing this in April as well. So first thing we learned about is income. Income is earning money through multiple avenues. Now see, when I say multiple avenues, why do I say it? It's simple. You cannot put your eggs in one basket. If me and Niranjan only relied on online coaching, we would not have been very successful, because online coaching means we have to depend on ads. And if ads don't work, or if supposedly social media doesn't work once, we'll be out there. So income has to be through different sources. So that tomorrow, if I'm taking a break, if I want a mental health break, or tomorrow if I have to travel, at least I don't have to focus कि अगर मैंने इस हफ्ते कोई class नहीं लिया है, I haven't done an art class, if I'm not taken a class, I will not earn. So that's why we need multiple sources of income. So we discussed about active income, coaching, training, freelancing, event income. We had discussed on what are the best topics that you can choose. In case you are not familiar with what is this active income, what is there, kuch nahi karna hai, just go to your group, and in your WhatsApp group, the first link you have to click. And all these, it's all about how to make the money, what are the 3 steps, how to do your AI money creating, how to find your customer on passive income. All of this is already given onto it. So you don't have to worry about where will I learn all of this. I've given in detail. Then we learned about passive income. Passive income could be digital products, membership, AI powered book sales, all of these things we learned. I also taught you how using ChatGPT you can create all of this. So I had asked all of you to start on a project. Start with a project, either active, either passive, and work onto it. You are already hearing some of them, how they've launched their project, how they are working. Next week, I will be after the sales and marketing class. I will be sitting with you all and working on your projects. In case your project is already ready, let me know. I will get on to a one-to-one call with you and take it further. Okay. And then there is an income on investment based income. Basically, you are not really every month, some income is coming based on how you are investing in your stock market, on your affiliate marketing. Again, these are, you'll get more in touch with these details today. And then finally comes your savings. Savings I have not really discussed a lot today. She will tell you. Investments, of course, you learned a lot from Somnath sir about low risk, moderate risk, high risk. Today, Rashmi will tell you not only risk, what is risk and what is return in a very basic thing. And final, it comes about spending, where you spend your money on. This also I've explained you. Spending and spend your money on experiences rather than things. Okay? So all of this comes to our wealth framework. Income we know, investments we know. Today we learn a little bit more about savings and investments. And the best person to do it is not me, because I also recently, like only 3-4 years back, had started really looking after my finance and doing it. And because even from coming from an IIM, I used to be very shy and scared of starting this world of finance. By the time I wanted to learn, I was already 28, and then I could not ask questions to people like, what is holding period, what is tenure, what is this? And in the end, I got so scared of it, I never did it. I always used to rely on, say, my dad or my male friends to help me do it. But once I started getting empowered with this feeling, it changed my life. And one of the people who has heavily encouraged me and inspired me in the last year is this person called Rashmi. Now, how I know Rashmi is a very interesting story. Me and Rashmi know each other from the first batch of Soul Group. When Niranjan had launched an art class, me and Rashmi had joined it together. And we were in the first batch. So she has been lucky enough to see both of us fall in love online and, start dating, get married. And I still remember 15th August was the day she took a retirement, early retirement from her work, because she called it her Independence Day. She wanted to work on a new project, the new project being her baby. 1 year she worked on, she disappeared. Of course, she had her child. And then recently she came back to us and said, now, Sanchari, I'm ready to start my career 2.0. Rian is a little elder, bigger now. He's attending play school also. So I have that 1-2 hour in between and I want to make it work. It started from there. She started using these 1-2 hours when Rian was sleeping or when he had gone to office, sorry, when he had gone to preschool. And now she has, I think, now 3 to 4 active active paying clients who she's a financial consultant to. She gets called to talk on conferences, and every week she tells me LinkedIn से एक नया engagement आया है कि नहीं आया है. The sky is simply the limit. She was called to speak on the 1% club on Women's Day. So many things are happening. And if any one of you says, I'm just a mother, I have a young child, I can't do this, I can't do that, or after maternity break, I'm not able to come out, I'm not able to do this, she is going to debunk all these myths for you. On the way to becoming one of India's best financial coaches who has a very different perspective on things and doing it, we have the founder of Rupee Smart Drive today, Rashmi, with us. And thank you so much, Rashmi, for doing this, because it takes a lot of patience to go through the basics and all of them and teach. But you have been working so hard for this class today. Over to you now. Thank you so much, Rashmi, for doing this.
Thank you, Sanchari.
You
Thank
can.
you for that beautiful introduction. I want to thank each one of you who's turned up on a Saturday morning, investing time in this masterclass. So it's absolutely not free, like you can see. It is an investment of your time, and I hope to give you the best returns on this investment. So, what is the objective of this masterclass?
I'll
Yeah,
just
sure,
finish.
Sanchari, you want to say something?
And yeah, one last thing is, you remember when we had gone to the Soulfest pyramid in front of that huge Gandhi, we were having a
We had a
conversation.
one-to-one, yeah.
We had said that we want to do something for women, because in this age of AI, if they're still not able to be empowered, when will they do it? It's become so easy to ask questions, to learn. And I see that vision coming true when we said that we want to make India financially literate, financially empowered, taking the fire possible. I'm getting goosebumps that if nothing, we are at least on the steps towards there. And soon we are going to do this for thousands of women. I have goosebumps thinking of the vision. Very excited to do this. Chalo.
Absolutely, absolutely, absolutely. Very, very excited to kickstart this investing masterclass. The objective of this masterclass is not to overwhelm you, but to make you realize that you actually know more than you think you know. So it is going to be a big common sense sort of an approach, and I will need a lot of your participation to make this happen. And when we think of this realization, the end objective is that you gain that confidence and clarity in your investing journey, irrespective of where you are, whether you're a beginner, you're in the middle, you're planning your retirement, it doesn't matter where you are. You have to feel more confident and have that clarity in your thought process around investing at the end of this session. And that will be the most satisfying outcome for me. How do we achieve it? With lots of participation from your side in the chat box. Having said participation, I'm sure you've heard of this phrase from Sanchari before. If you haven't, hear it now. Participation equals paisa. So the more you participate, the more you get out of the class, and it will be a return on investment of your time, right? So if you participate well, you will learn more. Having said that, save all your questions for the Q&A at the end of this session. But if you do not understand something I'm saying or a term I'm explaining, please put it out in the chat box and we'll pick it right there so that all of us are running at the same speed and we are part of this together. All right, having said all of this and laid some ground rules, let's get started. I will share my screen. Sanchari, I think you need to give me access.
Try now. It should be
Yes,
done.
yes, yes, it's working. Let me know once it's visible though. It has to be the agenda slide. Right, okay. Can we all confirm that we are able to see the screen? Is the screen visible? Yeah, perfect, thanks. So invest smart, invest right, basics to action. That's the name of this class. So you should learn smart investing and investing in the right places. And also we will cover the basics so that you start right where it starts, the concepts, and then we end with actually doing a live investment, right? That's the flow of this class. Moving into the agenda, the first part will be some concepts, very basic concepts, just a quick slide on what certain accounting terms mean, assets, investments, liabilities, and we jump into a quiz to see how we can place these terms. So this is a brush up for people who have taken up commerce, know things, know a bit of concepts already and do a bit of investing, but this is just to bring everyone up to speed. And then we jump into the types of investing avenues, options, choices, products out there. We will look at all of this from a risk versus returns angle. And once we have done that, we will have a live activity around goal-based investing. And then, of course, how do we start? How do we start in the live, real world? Then we do a quick recap, again, just a slide, and then we jump into Q&A. That's what we are here to achieve. Starting off, a quick introduction about me, if you all don't mind. Is that fine? Can I just take a couple of minutes introducing myself? Thanks. So as you can see, I'm a chartered accountant, a financial risk manager, and also a SEBI certified investor. I have about 16 years of corporate experience in those organizations that you see on the slide there. And this was predominantly in my CA and FRM space. And then currently, I run Rupee Smart Drive, which is my personal finance brand. I'm in my Ikigai space. The term, I guess, most of you are familiar with. If not, it is sort of right in between what you love doing, what helps the society, what helps people, what helps you serve, and also what helps you make money, right? So this is right in between that. This is the Ikigai space for me, Rupee Smart Drive. It's my personal finance brand, where I empower people to make right and smart financial decisions. So in this space, I am a personal finance speaker and a coach. Like this role today I'm playing is that of a coach. I'm also a financially free mom, and my financial freedom story has been covered by 1% Club. I'm a speaker member for 1% Club, started by Sharan Hegde. Some of you might be familiar with him. He's quite popular on social media and one of, like those unicorn financial coaches in India right now, right? So that's the space I'm in. As a financially free person and a financial free mom, I'd like you to take you through my story as well for a bit. Right. So 2008 is where it all started when I qualified as a chartered accountant. So until then, the whole idea was to study well, get a good job, earn, and spend as much as you can rather than, keep asking parents for money and not get enough, etc. Right? So that was what it was. But as I started my work life, and in a couple of years, I realized that I was in these illustrious big four companies, Ernst& Young, KPMG. So life was pretty hectic. Weekends also meant work most times, at least 50-60% of the year. And long hours in the week was a given. After having seen that life, I realized that if I were to ever have a husband, a child, a beautiful house, and put up my feet for a bit, especially live those early baby days fully and not have financial pressure, I realized that I would need a big pot of money before my biological clock turns out. And that is when I started to aggressively save and invest was more secondary, but saving was primary in my head, where I thought that the more you save, and whatever you do with the money, there will always be enough. But I realized slowly as I went into this journey that just saving was never going to make it, because inflation and taxes were always going to kill whatever money you had and the purchasing power it brought itself with. So I then had this new target of making 1 crore before I turn 30 and then putting up my feet, because I think this 1 crore number was put into my head by a friend. back in the day, around 15 years ago, where it really meant a lot of money, saying that if we had that much, we could forget about appraisals, promotions, feedback, and all these long hours and actually take a break. So I realized, okay, 1 crore should be good enough. And I started understanding that if you have to get to these aggressive targets in quick years, etc., you need systematic investing. Also, you cannot do this just with a fixed deposit. And that's when, in a couple of years' time, I stepped into the equity market. I started to buy shares by myself directly. I was not a mutual fund, a systematic investment plan sort of a person. This was also because I used to save aggressively, and I had enough money to buy stocks directly as well. So that was my first step into equity market from 2013. 18 is when I discovered this term called FIRE, which is very popular in the recent years, right? Which is financial independence, retire early. And I understood that that is exactly what I was trying to do, and it resonated with me. So that gave me all my calculations and formulas to say what is enough and how much is going to be needed, etc. I hit that target in 2020, but 2020 being the year of COVID, it took me another year to kind of come to terms with the numbers I had, with the life I wanted, my biological clock, all of this put together. So it took me a year. And in August 2021, like Sanchari mentioned, the 15th of August 2021 was my financial freedom day. And I even put out my one of those rare posts on LinkedIn back in the day. I was never active on social media until then, and that was my first real post to say, "Hey, I've done this, and I would love for anyone to, understand and see what I've done." So I was very proud of myself, and that's when financial freedom happened for me. And later, like Sanchari explained, I had my child, so I became a financially free mom. Now, moving on to the next slide, if this journey is inspiring enough, let's get into the concepts and see how we can relate to this journey ourselves and if this will inspire you to take action today. Right, so some basic accounting terms. Profit, loss, what does it mean? It's incomes minus expenses, right, for a business. So this is, we are looking from a business and an individual standpoint, right? But business and profit and loss is more used in in the context of a business rather than an individual. So when you earn more income, have less expenses, you earn a profit. When it's the other way around, you have a loss. The three elements of a balance sheet are asset, liability, and equity net worth. So let's look at what is an asset. Whatever you own, right, including investments, are assets. What are liabilities? What you owe to people, whatever is payable from your side, whatever loans you have, etc., becomes your liability. Equity in the business context is when assets, the value of your assets, exceed the value of your liabilities. That's when you have equity. And in terms of an individual, in terms of a person, it is the same term is labeled net worth, right? If you do not have excess of assets over liabilities, then you are in the negative where, it's where your liabilities exceed your assets, and it's the most unhealthy financial state to be in, right? So there's this whole range, and that's the last piece where, as a company, you're probably heading into bankruptcy, etc. Could be. Having seen these terms, are we clear on what these terms mean? Give me a yes in the chat box if yes. Some basic terms, we will discover more and learn more, of course. Great, thanks. So we will move on to the quiz now. Okay, before we move into the quiz, one more quick term: financial assets versus non-financial assets. Again, not going too much into the details. All I want you to understand at this stage is financial assets are somewhat intangible. This is cash, money in the bank, your shares, deposits, whatever. Non-cryptocurrencies, this sort of a thing, financial assets. Non-financial assets are more tangible. Your house, your car, whatever is, let's even call them physical for the sake of simplicity, right? Just have this understanding, and this will help you in the quiz, and you can give me a better classification possibly. Okay. Now to move into the quiz. Question number 1. Your jewelry from Tanishq, it's a diamond necklace. It's worth 5 lakhs, what do you think it is? Asset, financial asset, liability? Please type in the chat box. Great. Kinjal, you're right. Tangible asset. Nikita, right. Right, absolutely. I think you all got it. So the next one, your car. It's a Mahindra XUV 700 Ebony Edition. This has just been launched this week and costed you 30 lakhs to bring home. Asset, okay. Why is it a liability? Some of you are calling it to be a liability. Why is it a liability? I would like to know. When I look aside, I'm looking at the chat box. Just excuse me for that. All right. Okay. So to clarify this, right? So it is a physical asset. If you have bought it cash down, if you have borrowed from the bank as a car loan and then got your car home, then the car continues to be your asset, but the loan also shows up in your books as a liability. That is the reason I guess some of you are saying liability. In terms of the expenses it costs you, in terms of the value it loses over time, we call it a depreciating asset, right? Most physical assets are depreciating assets. At one point in time, even apartments were considered that way because of not actually having land in that space of things. But then the way metro cities grew in India, even apartments started to appreciate, and therefore real estate started to become this estate, this class of asset where people started to treat it as an investment, right? But otherwise, most physical assets are of the depreciating category where they lose value over time. But nevertheless, they are assets if you bought them cash down and you do not have a matching liability. Now, I think this will help you answer my next question as well. The house with 1 lakh EMI to repay on your home loan. So what do you say to this? What is your analysis of this? How would you record this in your books? Right. So this is where you need to understand that there is an asset along with a liability in this case, right? So the house probably is worth the amount you paid, let's say 1 CR in today's time or 1.5 CR in today's time. The loan you have borrowed for it might be, say, 1.2 CR, given that you would have done a cash down payment, etc. But having that liability plus having to pay that interest over a period of time for that whole term of the loan, right? So there are two things in your book, the asset for 1.5, but also the loan for 1.2 CR. And this means that by the time you clear this loan, you should have your house, which is worth a little more than whatever you paid, because the interest will make the loan for sure expensive than what you have borrowed. But at the same time, the house price should also appreciate accordingly to make it an investment, right? None of you called it an investment, but I'm saying that that is the criteria it has to meet if you are investing in a house property. And when I say investing in a house property, this is not the house where you are living. This is purely from an investment standpoint. I decided to mention this a bit in detail right here because I'm not a person who is a lot into real estate or cryptocurrency, and therefore you will see that that is not the focus of our session. But as a concept, I want you to understand that real estate is an investment only when you are looking at something that is not your home and not your own house, because that is something you will always want to be in and live in rather than sell at some point in time. It is no doubt an asset, and just like how in the olden times, people, women used to have jewelry as a safe, safe asset and a safe stop. Then it's more of a security for your bad times. But that is again very conservative sort of a planning and a old traditional sort of thinking. We will look at doing all this in a different way when we move across the session. Point number 4, let's get into something very different. A dream destination wedding that you are doing, and it is ending up with a number which is 35 lakhs. What is it? Okay, I see liability as the answer. Intangible asset. Okay. All right, liability. Right. So if you have borrowed to get your dreams true. If you have borrowed, then definitely a liability to the extent you have borrowed. But otherwise, 35 lakhs is a term that I briefly touched upon in the previous slide. It is an expense. It is not creating an asset because it is not a tangible thing, or there is no financial backing to this to give you any returns. Liability, of course, if you have borrowed, like I said, but it is an expense down the drain, which you will remember with beautiful memories, but is not going to fetch you anything in the future, right? So if that's your dream and an experience you really wish to have, do it consciously, plan for it systematically rather than borrow for it, because the borrowing will pinch you for many more years to come rather than the wedding itself, right? That's what I want to say with this particular point on the dream destination wedding abroad. And then the last one, Reliance Industry shares. You purchased 100 shares at 1,350 rupees per share, and now it's trading at 1,200. How would you analyze this? Great, it's an asset. Okay. What else? Yeah, agree with the point that it's an asset, but anything else that you want to add here? A concept that I will introduce soon. If Right, there is a risk. Absolutely. The risk is that if I want to sell this today and I need money, I will not be getting how much I have invested. I will lose money, right? Can I still call this an investment? Random thought. Can I have answers to that? Is it an investment still? Yes, it is an investment, absolutely. But is it a good investment if I sell it right now? Yes, absolutely. Kaveri, you're right. You don't sell and it appreciates. It is a good investment. But if you have to sell it today, you will, of course, incur a loss. So that's that on the quiz. And we will jump into the next slide. Well done, all of you. That was good. I want more participation as we go. This is just to summarize. We've discussed a lot. So, financial assets, what do they look like? Non-financial assets, what do they look like? Also, if people have joined in a bit later, this is a good place to start, where this is what we've done so far. Cash deposits, bonds, debenture, shares, crypto, like I said, digital gold, REIT. Digital gold, I think, is something I want to explain. If you buy, let's say, gold via something like a Google Pay, which has a gold vault, so they buy gold for you, they store it for you, but for you it is in digital format, and you do not get to see physical gold unless you take delivery of it. Digital gold could also be gold ETFs. We'll come to ETFs in a little while. REIT is a digital form of real estate investment, right? Real estate investment trust, that's what it's called. I'll type that out in the chat box for everyone. Right. Okay. So real estate investment trust is something like a mutual fund for real estate, where somebody takes money from a group of people, puts it into real estate, and whatever returns from that property, commercial, residential, whatever, mostly commercial is what we have in this space right now in India. So as you know, commercial real estate obviously earns a lot of rent, and the rentals are very good. And as individuals, we may not be able to afford commercial property. So REITs are our way to get exposure to commercial real estate and make returns from this, right? And these are not expensive. These are just like shares in mutual funds, where they are affordable in terms of single units. So that's what is real estate investment trust. Of course, mutual funds come under a financial asset category. Non-financial assets, I'll not get into the details. Like I said, that's not the focus of my session. So everything physical, tangible, but if you want to call a non-financial asset an investment, let it be a conscious decision of having invested in it in the hope that it will give you a certain return for a certain period of time, etc. Now, having said this statement, let's jump right into what good investing looks like. If you have been following me through this week, you should be familiar with these terms already. So when you invest in any product, what are the three attributes that you need to think of, and also ask the person if somebody is asking you to invest in anything, right? Growth. What is my growth opportunity with this product? What do I get periodically, which could be monthly, quarterly, yearly, whatever? And what is it that I get at the end of the investment, right? This could happen with a lock-in, without a lock-in. Lock-in means that you don't have access to that money in that period. Without a lock-in, obviously you have access to that money always, but what does it mean when I withdraw? Is there a restriction? Is there a exit charge, right? Or is there a capital appreciation, whatever that could be? So that is what you will need to think of, ask. Stability. Stability is very important in terms of capital safety and resilience. So if I'm investing 1 lakh, what are the chances that that 1 lakh stays 1 lakh always, or does it go to a 90, 80? Am I expected to be resilient about it, or that 1 lakh will always be 1 lakh but might become 110, 120, whatever, but the 1 lakh is guaranteed, it could be that as well. So it could be any of this factor is called stability, and that's what you need to question, ask for, think about when you invest. Liquidity, as we have discussed a little bit already, is the ease of redemption and exit. If you are being penalized for exiting any investment, then there is a charge there, and obviously your returns get impacted. Also, you might get lesser than what you invested because you kind of did it in that lock-in period and you were supposed to meet certain criteria. So you need to understand, is there liquidity in a product, right? When it comes to real estate, let's take this example just to explain all these factors, right? In terms of stability, a lot of capital gets locked in. So in terms of liquidity, it's not a great place for investing your funds that you need. So for example, if you have a need tomorrow, there's a emergency in the family, there is somebody who's sick, who has serious medical conditions, issues, etc., and you need 20 lakhs. Would you be able to get this 20 lakhs from a house that you own and you're getting rent from? Not really. And if you sell this house, it's also not liquid enough to sell immediately, right? There is a long term that you will have to there's a long time that you might have to wait, but that is not practical in a case if you are facing a medical emergency. Also, at the same time, you need only 20 lakhs. The house might be worth 1 crore. You do not really need to sell it, but you need access to that 20 lakhs at the time, which this house cannot provide, right? So now what does it mean? In your portfolio of investments, when I say portfolio of investments, please understand that this is a basket of all your investments put together. You need to have access to growth, stability, and liquidity in this basket, not necessarily coming in from one product. It could come in from different products. And therefore, how you design this basket and how you put together each element in this basket is what is crucial. And that's what we are going to learn more of in this session. Also, the last part, tax implications. Tax implications also can dent your returns, can dent your stability, can dent your liquidity, right? Liquidity from a lock-in perspective, a lot of these government schemes are more of lock-in based and then give you returns, and then if you have an exit at a time where it's an emergency, you may not get the returns that you expected. So that's the reason tax implications really need to be considered. We will look at tax in detail for what sort of investments it looks like for different investments ahead in the slides. So let's go from here. Is everyone clear on these three aspects? Give me a yes in the
1 minute, Rashmi.
yeah.
So before we go forward, first of all, when we are talking about growth, so much growth has come in terms of you as a coach as well. Like from your first class versus now, I was taking notes. You have got so good at this. It's amazing.
Thank
Second
you.
thing, I really have to give you credits for this. Second thing is, guys, all of your growth. I want you to take 10 seconds right now and tell me how much percentage of this have you understood? Because if you say 100%, I will not believe you. 100% even Rashmi doesn't know probably out of all of this in there. But kitna percentage have you absorbed it? This will really help Rashmi understand, because some of you might understand this, some of you might just be starting out. We want to take a benchmark of what is it going on. So quickly, guys, tell me itna after we have like learned some basics only, but these are the ones you need: assets, liabilities, investing. Yes, how much percentage of this are you understanding? Anything above 30% is good. Very nice. Anything above 30% is good. That means you are getting this. Very nice. Okay.
Great.
All
Looks
right.
good. So what I would like to say at this stage is, like I said, the presentation is designed in a way that you peel the layers of the onion as you go. So you might probably see more growth in this percentage as you unravel, as we unravel more and more in the deck. Also, at the same time, if there are very specific questions, I'm happy to cover them in the Q&A, and then that will help you address the gap in understanding that you're having as of now. Thirdly, also treat this class like a trailer to a movie, right? I want you to understand that these concepts exist. These are the concepts you need to learn. And these are the concepts you need to apply if you want to go forward in this journey. So, what is it that matters in the investing space is what we cover. A part of it you will gain from the basic concepts that I will tell you, but if you need to learn more and learn more in terms of application, that's the direction you will take for your learning gaps. And we will also consider and understand at the end of this class how that learning journey can be progressed with me or without me, right? That's where we will go with this. And going forward, are we all ready to invest? Like, I think Sanchari took a very logical break. Everybody's at a certain percentage, not fully there. Also, then, before you invest, there are three things that you really need to do. This will help you build up your risk appetite. I always talk about risk versus returns in an investment. And why do you need risk appetite in an investment? We've seen that in the previous slide, because you will have a problem of liquidity or stability when you exit an investment. And therefore, certain things in place will help you feel more confident when you invest, right? What are those three must do's before you start investing? Protect first, invest next. First part, have health insurance for all the adults in the family, especially senior citizens, because medical emergencies cost the most. Medical inflation is quite high and above the regular inflation rates. And therefore, medical insurance is a must, so that you have immediate access to funds and coverage when you have a medical emergency in the family, and you are not going to touch investments that are kept for the long term or are being affected by the market, etc. And therefore, that gives you peace of mind to forget about certain part of your money which you have put in for the long term, let's say for your retirement, for your child's education, etc. Otherwise, we tend to lose one thing for the other and compromise one goal for the other. That is the reason we need to protect first, invest next. The second piece being term insurance. This is especially important for the primary earning member in the family, which will be term insurance in the worst case of death, right? So at least there is no question of how will the family survive if the primary earning member dies. And therefore, this is an essential, and this will keep the family going, and there is a certain level of protection. This is very important unless you have like wealth for, wealth that can run through generations. Unless you have that, term insurance is a must. Third aspect being emergency fund. And this can be covered a bit through the investing products, which I talked through as well. But what I mean by an emergency fund is what is really focused on liquidity and stability and not so much of growth, so that you have ready access to funds at any given point in time. Let's say you have a job loss, or your business suddenly isn't doing well and not generating enough cash flows, etc. Then you need an emergency fund, which could be up to 3 to 6 to 12 months of your living expenses. This is whatever gives you peace of mind in terms of the number of months that you design. But here you need to have ready access to funds. So now I think you will be able to look at every product from this angle of stability, liquidity, and growth. That's what you should focus on when we go through the rest of the slides. And that is the reason those terms were introduced right at the start. Now, moving on, we'll start with the concepts of investing. Basic concepts. Principle is what you invest right at the start. It's also called capital. The rate of return, commonly it is the annualized rate of return, predominantly like in fixed deposits, etc. You will see it is 7%, 8%, whatever. That is what it is if it is already mentioned. But if not, we will see how to calculate that as well. The holding period is when right from the time you purchase that investment to when you exit it. Profit and loss, like we have been discussing. in the business scenario. Now, in the investing scenario, what is profit and loss? It is the income during the holding period. Whatever you get the income during the holding period from that investment, it might be named, it could be a rental, it could be interest, dividend, and then whatever you gain at the end of the investment, whatever amount you receive minus whatever the principal you have invested. This put together will be your profit and loss. We will look at this with practical examples, and that is when you will have more clarity on the numbers and what this actually feels like when you invest. Realized, unrealized profit loss, I think you've got a bit of a trailer in that Reliance shares example that we just discussed. If you sell it, you have a realized loss. But if you don't sell it, you are on a unrealized loss as of now. But if you hold it and then it goes up, the share prices go up, and then you sell it at a profit, that becomes your realized profit. So I just want you to understand that when the market goes down, it doesn't mean that, you get these fancy headlines in the news saying that, it's 20,000 crores of investor money is down the drain, etc. It doesn't mean that people have actually lost money. It is only a notional loss. Only if people actually sell in those times of distress because they need that money, then is when they actually incur that loss. So it's just a sensational way of putting things when markets go down and have a downtrend or whatever. But it's not a real loss. That's what I want to educate you with this particular term here. And we now move on with a practical example. Now is when the fun begins, because I want again a lot of participation. This is going to be an activity and we are going to do this together. This is how a balance sheet looks like. If you have never seen one, or if you have seen one, don't judge it on the performance of this company. It could be doing anything. I've just made a very fictional sort of a balance sheet. Let's call it the balance sheet of XYZ, right? XYZ company. And XYZ company, as you can see, has that much of assets, and they have matching a lot of loans as well. And at the end of the year, let's say they have a certain amount of profit. And now let's see how that translates for them in terms of their in terms of how it operates for the owner of this XYZ company, right? So we'll quickly jump into an Excel, and we shall. Yeah, so I'm jumping into a calculator Excel sheet. If you have access to Excel and you want to do this with me, most welcome. I'm just bringing up the Excel and I will be sharing my screen soon. Yeah. Okay. Right. So what we just saw is up there on Excel as well. Give me a thumbs up on the chat box if my screen is visible. Yeah, great. Thanks. So that's the same balance sheet that you saw. It's just the Excel version of it. Let's say there are there is certain amount of profits that XYZ company has earned, and we are going to now do two scenarios of this profit, right? Let's say the first scenario is where they earned, let's say all these are in thousands of crores, right? Let's make it feel and look big. That's how real balance sheets look like in the real world. So let's say this is 2000 crores of bank loan, 10,000 crores of debentures, 9,000 crores of unsecured debentures. All right. And I think there's a quick term to be explained here before I jump into the scenarios with the profits. I just want you to have clarity on these three terms. So the bank loan, I think, is very clear enough. You know that this company owes 8.5% interest to pay to the bank on the 2000 crores. Secured debentures are secured because they are backed by, let's say, land or plant and machinery, which XYZ company has guaranteed that if they do not repay this particular debt, then they can the borrow the person who has the person or the institution who has lent them this money can actually sell the land or the machinery and recover this money, right? So therefore, it's called secured debentures. And on this, XYZ company owes 8% interest. Unsecured debentures are another form of borrowing where the word says unsecured, which means there is no guarantee of these physical assets. Probably it's just a personal guarantee and all of that. So because it's unsecured, you can see that it is fetching 9% interest. So this is how risk return plays out in the real world, where the more risk you're taking as a lender, you're earning more interest. At the same time, in the worst situation, this person who has lent at 8% will still get his money back, but this person who has lent at 9% might stand to lose this money if this company goes down and isn't doing well, right? So that is what this looks like in the real world. Equity, like we explained, is the owner's share in the business, which in this case is 10,000. Let's say 10,000 is split as 100 shares into 100 rupees each. For simplicity's sake, it's 100 into 100. Now, coming to the profit scenarios. Let's say this company made a profit of 2,500 crores in a particular year. Okay. So 9% interest on the unsecured debentures would work out to be 9% into this 9,000 would be 810 crores, and then 8% would be on this 10,000 would come to 800. 8.5% on the bank loan would come to this. So the profit before tax. So this is another important concept to learn, where interest is paid out before you pay tax, right? So therefore, again, more likely that you will be paid your interest rather than anything else if you're invested in a business, right? So profit before tax is 720. Average corporate tax rate being 30%, that's your tax, and profit after tax is 504. So what is it that the investor in this company has made? It's only 5% because it 504 divided by 10,000 comes up to be about 5%. So now tell me, if you are an investor, would you lend money to this company or would you invest in their shares? So say equity if you are want to invest in the shares, or say debt if you are lending money to them. Okay.
Rashmi, 1 second. Can you show the calculation everyone against? So one thing, guys, I'm sure many of you would be like, why is 9% interest? I know basics also, it's there. Instead of using 9%, why did she use 0.09? Did you guys understand? Why did she multiply with 0 instead of 8% interest, 0.08? Everyone, guys, if you are stuck at somewhere, ask. Yeah, I did not get it. Those who got it, I know you'll get it. What about others? Exactly. It is just a shortcut she took, did not divide it by 100. How many of you do not know the term debentures? Have not understood what are debentures? How many of you don't know what does debentures mean? Any of these terms you don't understand from here? Debentures, okay. How many of you did not understand what is equity? What is accounts and receivable? Yes? Super. Okay. So yes,
All right.
Rashmi,
So
both
I
this
think for the sake of this discussion, we are focused on that liability side of the balance sheet. So debentures, for simplicity's sake, just consider them a kind of borrowing that the companies do to keep their business running. It's not a bank loan. So if it is a debenture, it is probably issued to the public, whatever. So there are different situations, scenarios, how debentures are structured. Like I said, secured and unsecured, we explained here. So these are all finer terms, but more for the purpose of this discussion, understand that it is a borrowing and not ownership in the company. A lot of answers came out to be investing in the shares. Now, my question to those who want to invest in the shares of this company, why would you want to invest in the shares of this company if you get only 5% return? Whereas, had you lent money to them, you would have been making much more interest in terms of 8%, 9%. It's higher, right? So why is this happening? So if anyone can type out or unmute themselves and explain this to me. Why is it that you want to invest in shares of this company? Okay, risk appetite. So why do you have risk appetite to do this and go through with this journey with them when they are earning only 5% for you right now? Okay, makes you a partner in the industry. Okay. Um it means you own the business, but would you want to own a bad business?
It's still
Growth
having.
might be more in future. Why would the growth be more in future? Because you trust this company, because you trust in the business model. Probably they have something going for them. This was just a bad year. So this is all in the presence of all this information and facts that probably you have access to and I don't, right? So at this point in time, if you ask me, going by pure numbers, I don't think I want to invest in this company if it's making only 2,500 crores of profits. Okay, so um, that is one reason I would say. But of course, if you are saying that it's still a profit making business, it's in a good place, it's unique, it is kind of almost a monopoly in the market, it does well, etc. It's just that it's starting out and therefore, it's still in its growing stages and therefore the profits are lesser, but you have confidence in the business, then of course go for it. So now with this, you have all realized that you do know more about this process than what you actually think you know, right? So if you know that this company is doing well, you would invest in the equity despite being less profits at this stage. Now let's take a clear cut, easy situation, a different situation where the profits are much higher. Let's say they are 3,500 crores. Let's see how this changes. Now you're making 12% on equity, 12% as an owner. Now, I think it's a very clear answer that you would all want to invest in equity, but not in the lending, because as an owner, my profits can be endless when I have more and more profits. But as a lender to the company, my gains are limited to the percentage that is dictated by the terms of my lending agreement. In this case, a debentures is also like a lending agreement which you have entered into, right? So where a lender has said, you give me this, and this is what is the terms. You have to pay me on the 5th of every month, whatever. And that is what is that 9% when you get. So that's what this looks like. Now we'll move on to the next scenario. This will take you more closer to what it looks like in the real world, right? So all these things that we just discussed in terms of profitability, if the company is has a good business model, is doing very well in the world in terms of being a monopoly, trying to sell something unique and has good demand, etc., etc. All of these study of these aspects for a business before you invest is called the study of fundamentals. This is something I want all of you to make a note of. If you want to be investors in equity and shares, etc., it's called the study of fundamentals. And going by the study of fundamentals, I will now showcase how value investing works. Okay. So what value investing as a concept means is that the shares, as you see in this balance sheet, are priced at or priced or issued or whatever at 100 rupees, right? Now, if this company is earning 3,500 crores of profit, giving you 12% return, what do you think the price of this share in the market should be? Just think of a market. Don't think of a stock exchange. Don't get into the jargon or the complications of it. If you were to buy this share, would you think that it would be priced at 100 or would it be priced above 100 for a good company like this, giving you 12%, etc.? What do you think? Above 100, less than 100? Absolutely, absolutely, right? So now, what if I told you that you should be actually buying shares of companies that are doing very well, but for some reasons are not placed correctly in the market from a price perspective. And this particular company is selling at 90 rupees in the market. Would you buy it when it's giving you 12% returns? For some reason, it's being sold at 90 rupees right now. Absolutely, yes, absolutely. Right. Okay. I see a few. Please repeat. Don't understand in the chat box. Let me just go through this all over again. So if this company is making a profit of 12 percentage for you, and the shares of this company are priced lower than 100 rupees, which is only 90 rupees in the market. Let me put this down and call this the market price. Then you are at a gain, you are at a benefit if you buy this share at 90 rupees from the market, because when this happens, so if when this happens, the shares will go up because it's a profitable company, and we said all those good things about this company, right? It's a growing company, it has good scope, etc., which means people are lining up to buy this company. And therefore, if it's being sold at a discount of 90 rupees, it is a very good buy. And from a value investing perspective, we say that this is undervalued, right? This company is undervalued when it is being sold at 90. And let's say if it was sold at another scenario, 110, this company is overvalued. Now, a while ago, I told you that there are the study of these sort of factors is called the study of fundamentals for investing in the market. What if I told you that these fundamentals have indicators and you can actually identify from the sea of companies there is, you can actually go and identify which companies are right now selling at an undervaluation, which means they are more valuable than what they are being quoted in the market at because of their profitability, etc. Okay. So how to identify such a company is what I will show you on in the real world. Um, are all of you in for this, or is it too complicated to get into the real world at this stage? Great. Thanks. So let me again stop sharing my Excel and we can get into internet, Google Chrome. So if you have, like I said, you should all have access to internet for a good experience of this class. So if you have access to internet, I would all encourage you to open your internet browser at this stage. And let's open something called the Economic Times Screener. Just Google for Economic Times Screener. And you should be able to see my screen as well, but look for Economic Times Screener on Google and you should find something that looks like this. Okay, so my screen is just coming up. Right, so it's called the Economic Times Stock Screener. Just look for this Economic Times Stock Screener. And so for this example that we were looking at, right, 90 in the real world versus 100 in terms of book value. So whatever is in the balance sheet is called book value. This is again an accounting term. So this ratio is called price to book, right? Price to book ratio is what it is called. And you need to look for price to book in these list of screeners to see which have a ratio of less than 1. Right, when you see 90 is to 100, it is less than 1. If it was 110 is to 100, it would have been like a 1.1, right? So any company with a ratio of price to book being less than 1 is what we look for. This is just an example screening that we are doing. We are not going to look at, okay, so price to book. Yeah, so I've just applied for it in the filter because I couldn't find it in the predefined ones. I'm saying price to book, okay? I'm ticking that box. I'm saying 0 to 1. Minimum, maximum is what they've asked. I'll say 0 to 1 and we hit go. So I don't want to really save this screener. I'm just leaving it as untitled. There you see a few stocks have actually turned up. Anybody familiar with any names here? Do you know what these companies do? Of course, there is a line there. It's already telling you, but have you heard of these names before is what I'm asking. Yes, absolutely. Dr. Reddy's is a known name in the pharma sector. And If this sort of appeals to you, now I will show you the next step. NMDC, absolutely. NMDC is a PSU. So again, a matter of fact, or rather a matter of, information, awareness, whatever. So Dr. Reddy's is more in the private space. NMDC is a PSU space. So the default thumb rule that you should think of when you think of these companies is that PSUs generally happen to pay more dividends and are more considered like retirement stocks for people. Dr. Reddy's might be earning a lot of profits, might not necessarily pay dividends, etc. So this is something of a thought that you should think of, but it may not be really true, and we will do detailed analysis. So let's say going with these two names, we can go and analyze further. So the next tool we will be using is called the screener. It's just called screener.in. Just get into screener, and there are sections for so right, that's how it looks like, the home page when you open screener. I'm going to type in Dr. Reddy's, and this will give you all the information about this company in terms of the financials, right? So not necessary that you would know everything here or you would need to know everything here. I will tell you what are the key indicators to look for, and if someone can type that out in the chat box, that will be useful as we go along, right? Now, okay, what should we be looking for? A return on equity. You can see that this is 21.4%. This is corresponding to that 12% that we were looking at in our example, right? Which means this company is actually giving 21% returns, or rather, this is the latest returns that they have given on equity. Equity being the ownership, and you are looking to buy shares of this company. So this is one factor you will look at. Dividend yield is 0.67%. I will not focus on this at the moment, but just know that dividend is something which is a profit payout. So if you are earning 21% of the money as profit, this company has chosen to pay a part of that as dividend, and we shall see how much that looks like. Okay. So dividend is a physical payout of that money, but you have earned much more, which will reflect in your capital appreciation. When I say capital appreciation, in the price of the company share that is expected to go up due to good profitability. So coming down, you will see this is the price, how it has fluctuated over a period of time. 1,200 is what it looks like. All these arrows, what you look at, these are called, this is the volume. Volume being the demand and supply of this particular share in the market. So there is a, so let's quickly talk about why do prices fluctuate in the real market, right? Market is where you're buying, you're selling shares. Let's keep it as simple as that. When you buy and sell something in any market, let's keep stock exchange and stock market out of this conversation for now. In any market, if you are buying and selling, prices will fluctuate. Why will the prices fluctuate? Can anyone with a bit of economics background, that's a clue for you, all of you right there, tell me why would the prices fluctuate when people are buying and selling in a market, in an open market? Anything. This is nothing to do with shares, but just an open market. Okay, speculation and worth, correct. What else? Just two words is what I'm looking for. And that person is going to get a gift. Okay, Dr. Jury, you've hit one word. I think the other word is now a given. I want someone to say that. Get both the words. Yes, Dr. Juhi, demand and supply. Absolutely. So this entire game of price fluctuation in the market is a game of demand and supply. And why am I calling it a game? Because nobody can really predict demand and supply, right? What are the factors that drive demand and supply is what determines what the price will be, and also these factors are what tend to get discussed in the news, in the open space, etc. And therefore, you hear markets are going down because Trump has announced tariffs, this, etc., that. But actually what is happening is because Trump has announced some tariffs, now it is harder for us to harder for us to export goods out of India to US, because they are now more expensive for US to buy from us. And therefore, we are saying that the demand from US will fall for our products. And because of this sentiment, the markets probably will go down for a particular sector. Let's say an IT sector, let's say pharma sector. So you listen to things like FDA. FDA is the pharma regulator in the US, right? FDA sometimes rejects a drug by Dr. Reddy's. That is the day Dr. Reddy's shares will fall, not because Dr. Reddy's is doing badly, but probably a large consignment or whatever they had in their order books is all up for rejection and they will suffer a loss in the immediate future. So it's not because Dr. Reddy's is a bad company, but it is affecting the sentiments of those who are buying the shares of Dr. Reddy's in that moment. And also, given the interplay of demand and supply, you see a lot of trading in the markets, right? Trading is all short term, which means you're only running based on these sentimental factors, these external factors, etc., and taking a bet, placing a bet, saying, this is what I expect to happen and this is what I'm going to do. This has nothing to do with long term investing because ultimately, like we were now talking about, probably Dr. Reddy's is a very good company and it will survive the long term and survive this small hit of one drug being rejected by the FDA in the current scene. So that is how the real life looks like. But then at that moment, you might feel like, oh my God, my Dr. Reddy's shares have tumbled. Does it mean that you will incur a loss? Dr. Reddy's is a bad company? No, right? So this is what it looks like in the real world. And therefore, you need to keep an eye on those ticks coming back to the screen, right? You need to keep an eye on these blue, long, short, whatever those strokes are, because that is what is indicating that there is so much demand supply for this particular share on those particular dates. So basically, this is running from April to Feb, whatever, right? So that is if you are getting into the study of demand and supply for the sake of trading. Now, again, taking a pause and diverging a little bit, there were a few of you who are interested in trading in the stock market. So if you really want to trade in the stock market, I am not covering that in this class. But what do you need to focus on is things like volume and the study of demand and supply in the market, which is called technical analysis, right? We said fundamental analysis was for investing, technical analysis is for trading. So if you want to study and become a trader, technical analysis is where all the fun is. And technical analysis, you will see candles, etc., candlesticks, etc., which I do not want to showcase today. A few of you have already seen it in Dr. Somnath's classes, and you will be aware of that. And probably you've started your journey on that side. But today's class is about investing, and I do not want to overwhelm my audience by showing candlesticks. It's really an entire universe in itself, where just like investing is. So for the purpose of investing, you can stick to the screener as of now, and you can look at the data that we want to see, right? Now, what else will we look at? Well, let's look at, let's say, PE ratio. Okay. So PE ratio is what is price to earnings ratio. So price is the market price to whatever the company earns. That is price to earnings ratio. So the price is, when you say PE ratio is 20.7, the price is 20 times the earnings per share. Earnings per share is EPS, what you see there. So they earned in August 2023 56 rupees per share, and the price was 20 times that. That's what price to earnings ratio means. And this is a good and a very important indicator. Just know that this exists as of now. We will see how to use it as we go. Okay. Now, moving on. This is something which is very nicely populated for some shares, but not for this one in this situation. I'm not sure why, but anyway, the pros, it says it's delivered good profit over last 5 years. There are no cons. Now, what is it that we will look at in this table? This is a comparative table with its peers. So you see all other leading pharma companies in this table versus what Dr. Reddy's is doing. So if you see price earnings ratio, it actually is trading at lesser than the other companies. Other companies are trading at 36 times the earnings, 25 times the earnings. This is trading at 19 times the earnings, which means it's going with our assertion that it is slightly undervalued and probably is a good buy. Now, when will you decide whether to buy or buy this company or not? Few more factors to see. You will see if the operating profit is consistently growing. Seems like some problem here, but otherwise pretty much yes. And Are they paying taxes regularly at a good rate? Yes, looks like. This is an important indicator of whether this company is compliant. Okay. So if you open Adani in this case, right, you will see that these are very irregular. And for some reason, it is irregular. Now, whether you want to go with this company, you're willing to take that compliance risk is up to you. But these are indicators that you need to look for when you make your decision to invest in a particular company. So earnings per share is very interesting. If you see, it's been growing pretty well, but again, it's kind of peaked, or it's kind of taken a stable this thing. You see, like you feel like it's probably not really growing consistently, and probably that's the reason for it being undervalued as well. So if you see the dividend payouts, pretty healthy at certain times, 35% paid out of the 11 rupees they earn, but certain times it's just 15, 12%, whatever. They might be retaining more profits to expand, to grow, whatever that reason could be. So that's the dividend payout. And now, if you go ahead with this, you will also see the balance sheet where what you are supposed to see even more ahead. Let me see. Um, in the balance sheet, no, nothing in the balance sheet that I want to mention at this stage. Shareholding pattern. This is something very important that you need to see. So promoters, if they seem to reduce their holding, then maybe there is something wrong with the company, because they are probably washing their hands off and unloading their problems on you, right? So you need to look for this indicator as well. So these are some indicative indicators. Like I said, this is again just a trailer to the movie of fundamentals analysis that you will need to go in detail for learning equities and shares and all of that. Now, if we have to go back in terms of our slides and where we were, we came to Dr. Reddy's because it was an undervalued company and we saw all these indicators. Now, open question, after having shown you these indicators, having seen their profits, whether they are growing or not, their dividend payout ratio, etc., of how much ever you have understood of this company, will you buy it? Will you not buy it? Is a question, is an open question. And now, for a change, there is no correct answer. This is all about your risk appetite and confidence in this company in terms of whether you think they will do well and they will come out of their problems and start growing fabulously, whatever, right? So Dr. Jury, Priyanka are willing to take the risk. They are going to buy Dr. Reddy's. All right, great. Yes, Vandita, absolutely. Undervalued, overvalued will depend on the current situation. And buying undervalued companies always gives you a safer bet because their financials are stronger than what the price in the market is. And therefore, as investors, we should always look to buy undervalued companies. And therefore, market fall is the right time to have this class, this awareness, and go out there to start fishing for good opportunities. All right. So let me stop sharing my.
Me take 1 minute here, Rashmi, while you hydrate. That was
Yeah.
wow, a lot of things. So I want to tell all of you, I know because many of you were messaging in the here also and all. This must be a little overwhelming seeing all these figures and maths. See, understand that what Rashmi showed you today is not for you to start buying stocks today itself and finding what is undervalued. That is not the expectation here. What she's trying to show you is that if you today were to tomorrow run stocks, you just using some small indicators, you can make a call on what to buy and what not to. Today nobody is if you are confused at this point of time, you should be confused because it is just a trailer. Nobody's and you won't be able to do it just by hearing this. But what Rashmi wanted to show you is that just by reading one document, and that document is available globally to everyone. All this information is outside there. If you learn how to read these information, that's how you are going to do. So don't get upset if you feel you are not understanding it. Don't give up. Just the trailer, keep going with it. Soon you will be able to read and interpret this. It's a new language. It's fast also because we just wanted to show you the scope of this. Now, to read all of this, explain all of it, you'll have to go through, I think, 10 to 15 sessions with Rashmi, learn all this. But you are taking your first step today. Okay, just understanding that tomorrow, what is it that a stock person does. Be it you who will start or be it the stockbroker in Bombay Stock Exchange, everyone will be doing these same steps only. So today we are seeing the trailer. One by one, we will simplify it along we go. And Rashmi has tried her best, and it is such a complex to explain this. Thank you so much, Rashmi. Let's get on and understand more about more debentures.
Thank you,
Very nice,
Sanchari.
very informative.
Thank you, Sanchari. There are a couple of questions there which I would like to quickly address: undervalued versus overvalued. So, commonly, what do you see in the market is that very good companies are always mostly overvalued. Okay, because companies doing well, there is always a demand for them. And there are not just traders in it, but also investors like me and you. Therefore, they are always overvalued. And actually, buying stocks undervalued is something very rare and very difficult to find opportunities. And it is actually easy in a falling market like what we have today. So until last year, you would have also heard this. If you are in touch with the business news, etc., you would have heard that Indian markets are overvalued and they are, due for a correction, etc., etc., which meant that most companies or a lot of the companies in India were actually trading beyond what they were really having backing as a value in terms of what their real values were. But people were still going in for it because, again, we were in that uptrend run, and there was demand for those stocks. That's why the prices kept going up. But this is the time when certain companies have come down and you have that undervaluation and you have some good opportunities. So, thumb rule, all good opportunities mostly will be overvalued. If you find undervalued companies that are doing well, those are really, truly good and precious buys that you should jump in and jump in and sort of leap at the opportunity, right? So that's what it is about: undervaluation and overvaluation. Now, moving on, we were actually supposed to do debt investing after this slide, but we went into equity a lot because we understood what undervaluation and overvaluation and in the real world what these things look like, right? Now, moving on to the next slide. Quick one, risk versus return. This is to simplify your life when you apply to any investing term, product, whatever it is, debt, equity, it does not matter where you're investing. We are applying risk versus return, right? So how do we apply risk versus return? In this slide, you will see that risk is on x-axis, return is on the y-axis. And as you take more risk, your returns are increasing on this particular arc of a line. At the same time, after a certain level, it seems to be topping off. There is no real returns coming out of taking more and more risk, right? So this particular arc, it's a very theoretical concept in portfolio management, this particular diagram, which is called the efficient frontier and efficient portfolio. So when I say theoretical, it is a dream for every investor to achieve, which doesn't really happen in the real world. But what you need to take away from this diagram for the real world is that taking unnecessary high risks does not always mean higher returns. So there could be a product that gives you this much of risk, but only very less returns, which is a red flag completely. Higher risk, but gives you like, okay, decent return, not the maximum return. So probably this is where your risk appetite lies, right? You're okay to forego this much, but at the same time, you are more convinced about this opportunity. Here we are saying you're getting a lower return for equal risk. There is a scope to get much more out of this, but you're getting a lower return, right? To give you an example for this one, let's say there are FD opportunities in the market right now for Canara Bank, for HDFC, and there is a AU Small Finance Bank. Okay, so Canara Bank is probably giving you 7%, HDFC somewhat the same, 6.5 to 7.5, let's say that's the range. But AU Small Finance Bank is giving you something like a 9%. Okay, now it is a similar product, right? FDs, you can say more, okay, more or less somewhat the same sort of risk, but your returns are much more in the small finance bank. Now, you might argue that, of course, these the Canara Bank and HDFC are probably much more larger. They will not pay you interest. The small finance bank might shut down tomorrow. Agreed. So this risk is addressed by RBI. This is a quick bonus tip for all of you. I know no matter what we say, people will have money in FDs, and you need to know this if you have money in FDs, that RBI guarantees up to 5 lakhs for every individual in any bank, right? So if you have a deposit up to 5 lakh, which has to be principal plus interest, not just your principal being 5 lakhs, you are guaranteed by the RBI that you will get that money irrespective of the bank operating or not. Now, of course, it might be something of a far off dream when RBI really comes to pay you when the bank defaults. But in any case, there is a provision like this, which means your money is safeguarded and somewhat you will get it even if the bank fails tomorrow. So given this situation and knowing this information, now you might actually opt for this AU Small Finance Bank saying, I will still do an FD, so somewhat same risk, but I will earn a slightly higher return, right? So that is what is sort of a example in the real world. But like I said, this is highly theoretical and nothing will match in terms of how the real world looks like, because no risk is really equal across two products. There will always be certain things that will make every product different from the other in terms of risk versus return. But when you look at any product, try to visualize where it falls in this frontier and are you okay with going with that sort of risk and that sort of return. Understand what your options are, what your parallel options are, etc. Like I gave you this example of FDs across 3 banks. So similarly, we'll discuss more examples as well. And that is the reason we are introducing this concept as of now, so that as you go along, you will see more and you will be able to apply this better. So moving on to the next slide. This is all debt investing options. So basically from that balance sheet, we have realized that you can either lend to a company or you can own a piece of that company. So lending to a company becomes debt investing, whereas owning a piece of a company becomes equity investing. So what are your debt investing options in India? Okay, this is what this slide is all about. It's all in one place. You will have to, of course, research each of these products more if you want, or we can do a detailed session if a lot of you are interested in this, right? So like we spoke about, the first example is already done. Deposits was in PSUs versus large banks versus small banks. Debentures, we've discussed a bit of this. It's again a form of borrowing for companies, and it's a lending agreement. This could be between institutions and those banks. I mean, sorry, institutions and those companies. It could be banks, it could be mutual fund institutions, it could be a LIC, etc. Right? We'll see this again in the next few slides, who these are. And secured, unsecured, we've learned. Non-convertible, what does this mean? So there is something called convertible debentures and non-convertible debentures. Convertible debentures are those which after a period become equity, right? So that product is more like a hybrid product and doesn't fit into debt investing. Non-convertible debentures are pure debt investing products and sit into the debt investing category. Of course, debt investing again can be further segregated as government versus private. So you have bonds from the government like gold bonds, other bonds like Power Finance Corporation, your Rural Electrification Corporation bonds, etc. So these hold certain percentage of interest and they pay out periodically. And then there is also, these also sometimes get traded in the market. So if you have lost out on the opportunity when they issued it originally, you can also buy in the market and get them to pay you some interest, etc. So that is bonds. Corporate bonds are bonds which are issued by companies. Companies can be, again, small companies, medium companies, large companies, etc. So you may not be able to classify risk returns. And that's why it will be good if you can take a screenshot of this slide for especially that green section there, which is giving you the risk versus return for bonds, right? If they are, these are just like if you went to borrow a home loan, there is a credit rating that the bank applies on you and does a credit verification and says, because you are good and you are paying your credit card bills on time, etc., you have a good credit rating, so you will get good rates of interest. Whereas somebody not, you might not get a loan, you might get higher rates of interest, whatever, right? So similarly, when a company is out to borrow, their bonds, which have featured in the market or have come out to issue, are rated by agencies which are like CRISIL, etc., ICRA, etc., who are all credit rating agencies in India with these ratings. So anything about triple B is considered investment grade and below triple B is considered speculative. Speculative means they are called also junk bonds, which means you might get it, you might not get it. It's like playing the lottery. But about triple B, there is a sort of risk reward balance, and also, of course, triple B bonds will fetch you more interest than triple A, etc. That's what you need to compare when you invest in these bonds. So there are a lot of platforms these days, online platforms, where you can just quickly do an online KYC and look at these bonds as options. It's like just like shopping on Amazon or shopping on these online platforms, right? It's similar to that. And I can give you names of this. We can go into details of discussion here if you're interested in bonds in the Q&A section. The last section there is all about the government schemes, which all are basically government borrowing from us in the name of Provident Fund for our retirement planning, Sukanya Samriddhi, Atal Pension Yojana, again, for the girl child, for retirement planning, etc. What is unique about these government schemes is they will come with a lot of lock-in periods. Of course, stability and liquidity is never a question. The government is not going to default because the government is like obviously the highest authority, and as a sovereign, as a country that matters in the world today, we are not going to default on government issue of bonds and securities, right? So therefore, these are always safe investments, but will not pay you the best. So currently, they all fetch you something like 7%, but they all come in with their own terms of tax benefits or lock-in periods, etc. Tax benefits, when I say, for example, a corporate bond that you buy, right? Whatever interest you get is completely taxable, but some of these government bonds might say this is tax-free interest. So when you see that tax-free interest bonds, etc., is where you know that you are going to make much more than that 7%. Because if a corporate bond gave you 10% and you ended up paying 30% tax, your returns are really only 7%. But a tax-free 7% return is going to be much more easier and safer when it is tax-free from the government, right? So that is how the comparison for tax happens in debt investing, where tax-free investments, tax-free interest obviously is a better scope, a better product to invest than something that is more riskier you're going for and paying tax as well, right? So that is debt investing. And moving on to the next slide. Equity investing, we have discussed how you own a part of the business, and some of you have understood this, but walking through the business cycle, right? At what stages does a company actually raise funds and where are our opportunities? Let's look at it that way. So right from when a business starts, let's say Soulflow Limited, for example, right? So when Niranjan and Sanchari have come together to start a business, at the start, it's just probably a solo venture. It was a solo venture by Niranjan. Then Sanchari joined and became a partnership. At this stage, what is their source of funding? Would be mostly self, family, friends sort of funding, because you don't really have access to public money, right? Now they are growing. They want to probably make it a private limited company. What is the motivation for businesses to become private limited? You want to segregate the company from your own individual identity so that the company's assets, liabilities, etc., can be reported separately, has all those tax benefits, etc., right? This also comes in with the cost of compliance. So that is the cost and a benefit aspect that most companies weigh in on. But for an expanding business is an inevitable. You have to go that way to expand and start doing much more in your business space. At this stage, you have angel investors, seed funding, bank loans, venture capital, etc., coming in and helping you out. And in the growth and scaling phase as well, you will see similar, but also institutional investors. When I say institutional investors, these are banks and financial institutions going ahead and buying shares of your company, right? Now, what happens next is if they grow in a scale that they want to go public. So private limited companies have a lot of restrictions in terms of the number of shareholders, what they can do, etc. But a public limited company can actually have like lots and lots of shareholders, lots of access to public money. You're on the stock exchange, etc. That's the reason a lot of companies go public. And at this stage, what happens, as we have seen in the market as well so far, is that people who have funded at the start tend to exit at this stage because they have had enough growth, enough valuation, etc. They are earning enough on that money already, and they tend to exit when the IPO happens. IPO is an initial public offering when these companies come onto the market to get listed and to also make it all accessible for people like us who are called retail investors. Okay, we are all called retail investors in this investing space because we are all investing in our individual capacities. At the same time, the other half of investing, or the dominant part of investing, is by DIIs and FIIs. You would have heard this term in the business space if you're familiar, which is domestic institutional investors and foreign institutional investors. So the current fall, for example, has been attributed to a lot of foreign institutional investment pulling out, thanks to, the falling rupee, our tax rates, etc., etc. So that is making investments in Indian equity sort of unattractive for them. And there are other developing markets and other spaces that they are going into, because also, I guess, interest rates are increasing. So they're going towards debt investing than equity, and this sort of demand and supply play from an institutional perspective. But as retail investors, it's in our advantage, like I said, to find opportunities in this space, to do more investing, because you will get at good prices at this time, right? So that is what is all about investing in the market as a retail investor. Once you're a public limited company and once you're already in the exchange, companies also raise funds through rights issues, debt offering, etc. So debt offerings were similar to what we already spoke of, right? Things like they'll issue a bond out in the market, etc. Rights issues are raising more share capital from the existing bunch of shareholders, because again, you don't want to liquidate that interest in the business, right? We saw how there is a constant share of promoter share in Dr. Reddy's, and we said that was not being liquidated, which was a healthy sign. Similarly, you don't want to liquidate too much, and therefore the rights issues are always given to existing investors. So that's what is equity investing. Now, how does this translate for retail investors like you and me? This is how it looks like. We have opportunities to invest in these businesses through a primary market and the secondary market. Primary market is when you're literally buying shares from the company itself, probably through an agent, probably through an institutional banker, investment banker, whatever, but directly from those shareholders, because like I said, at that stage, there are limited shareholders and you have limited access. So there is less transparency here in terms of what the business valuations are. You will see fancy decks being made, lots of valuations being shown, etc., because they all want to raise money, say that their business has great scope, but a lot of due diligence is required. When I say due diligence, it's a lot of research and a lot of conviction is required at this stage to invest, to say that I believe that this is a growing company and will make it big. So that is when you invest in the private equity space or unlisted market, or go for IPOs as well. Certain IPOs don't do well because, like I said, a lot of promoters actually look to exit after the IPO, and therefore, when the shares get listed, you see a downfall in the price because a lot of people have exited, and the sell volume is much more than the demand volume, right? So that's what happens there. So you should have conviction in the nature of business, the scope of business, and whether the growth opportunities of this business are good and will it do well. So that is when you go for an IPO or unlisted market space and private equity, right? So these opportunities are limited and you have certain platforms that give you access to these opportunities. The risks are higher. Sometimes there are higher thresholds as well for entry, which means that you have to block higher amount of capital as well. None of these restrictions will apply when you come into the secondary markets. What are secondary markets? These are basically buyers and sellers doing it in an open market like the stock exchange, right? So basically, this is all what we do in an NSE or a BSE, where in the stock exchange, you're buying based on demand and supply, like we explained earlier. What are your choices here? Exchange traded funds, direct investing in all these categories of companies, large, mid, small, and micro, and also mutual funds. We'll get to mutual funds in a bit, but this is all direct investing that we are looking at when we are buying shares directly from the market, and we are investing directly, not via, of course, via the broker, but that is just a transaction and not that they are representing us, right? So what happens in an exchange traded fund? We will look at that, and we will also look at all the large cap, mid cap, small cap, micro cap. What does this mean to you in terms of a layman view or a real view that you have? I think we haven't interacted for a while. Let's get back to a bit of participation here. Large cap, mid cap, small cap, micro cap. What do you think these terms mean? Anyone wants to put it out in the chat, unmute themselves? All right, I think there are no answers there. Let me quickly go through this. So basically, the top 50 companies of India are represented by what is called the Nifty 50, and that is the large cap part. The next 50 also come into large cap. So there is not a Nifty 100, but it's called Nifty 50 and Nifty next 50. This is all based on market capitalization, exactly like Vandita has said. Absolutely. So what is market capitalization? The number of shares a company has multiplied by the market price, which is the current market price, right? So based on that, the highest top 50 is what goes into Nifty 50. The next 50 also form part of this thing called the large cap companies. And this is where your blue chips are, which is basically the topmost companies and where your, in terms of equity investing, less risk, higher returns, or in terms of what to say, it's more stable, better the chances of returns when you take risks with large cap. As you go down this table into mid cap, small cap, micro cap, these are the companies are shrinking in size. At the same time, they could be your next superstar in terms of growth, in terms of the concept, etc. So if you ride the wave from a company being a small cap to all the way becoming a large cap, then that is when you have hit the pot of gold. But not every company really converts into a large cap, because we know that not every business is meant to scale, is meant to kind of succeed. And therefore, your bets are much more riskier when you invest in small cap, mid cap, and micro cap companies. Now, if you identify an opportunity, let's say you just heard from a friend or heard from somewhere that this company is good and it's trending, etc. How do you identify whether it is large, mid, small? What is it, right? So that is something I could show you. And of course, now you've already seen that you will also have the opportunity to go into the tool like Screener, ET Stock Screener, etc., to further study these companies, right? How to identify the indices, we will just quickly look at that, but I think I'll park that for um, at the end of the session, because I don't want to divert too much. Let's kind of focus on the slides as of now, and then we will park this for the end, where I'll show you how to identify a company being large cap, mid cap, etc. Okay. Now, moving down. So types of investing, we did all, which was direct, where you are picking the stocks, you are picking the bonds, etc. Now, if you want to outsource your risk return study, this is all so complicated, I can't do this, then these are your products, right? These are your options, because this is a managed way of investing where somebody is doing this risk return study for you, picking a mix of products, and you are able to leverage their study and their expertise in terms of getting good returns, etc. Now, what does it mean? You will have to incur a cost. It could be a fixed cost, or it could also mean profit sharing. Let's see how this looks like. So the top box here, if you see, this is more for all the middle class retail investors like you and me. These are the different ways it could happen, right? Mutual funds being the most popular product here. You could have pure debt investing products, you could have pure equity products, you could have hybrid products where they are into a mix of debt and equity, which is called something like multi-cap. Multi-cap goes across large cap, mid cap, small cap. It could be flexi cap funds, right? You would have heard of these terms. I want you to note down if you haven't heard, and if you don't know. So flexi cap funds are what will invest across debt and equity. Multi cap will go across large, small, mid cap, etc. So you have to study these funds to understand what is their ratio of investing, right? So if they're putting a lot of money into small cap, less into large cap, maybe that's not where your risk lies. You want to probably be a little more conservative, so then you probably go for something like a blue chip fund, right? Now, how do you evaluate the fund performances, etc.? There is a very easy way out. Now, what do you know? Nifty 50 is the top 50 companies. and Nifty 50 is the index of the National Stock Exchange in India, right? Similarly, you have a Bombay Stock Exchange with a Sensex. Sensex is BSE 100, again, the top 100 companies on the Bombay Stock Exchange. So these two are the biggest and the proper stock exchanges, authorized stock exchanges in India to buy shares and are represented by, like I said, Nifty 50 and Sensex. Now, if you have to go into this to understand what a performance of a scheme looks like versus these indices, this is the reason your indices are tracked every day in the papers, in the business news, etc. So if Nifty 50 has given you, let's say, 10% over a year, right? So what is the job of these funds? These funds are supposed to beat the Nifty. Otherwise, what you can simply do is invest in an ETF. What is an ETF? ETF is an exchange traded fund, which means there is no active management by the mutual fund. There is no active fund manager. As you can see in this picture, this is how a mutual fund works, right? You are pulling in money. The fund manager is now choosing the securities and the returns are going back to the investors. So there is no real active fund manager in an exchange traded fund. Exchange traded fund, what it does is simply mirrors the Nifty 50, right? So if the Nifty 50 has, let's say, 50 companies in ratios of, whatever, A to Z and beyond, and then based on that ratio and based on how Nifty 50 is performing, you will get returns by default. So unless any mutual fund beats the Nifty 50 or beats the Sensex, whatever, there is no point in investing in the mutual fund, especially the equity ones, equity ones specifically. Debt mutual funds are another ball game altogether. I'll cover about debt mutual funds, why you should do or why you should not do when we cover the tax piece, okay? So right now it's about equity, and equity, like I said, any equity mutual fund that you identify should beat the ETF. If you cannot study all of this and you just want to understand and get a taste of what investing in equity feels like, exchange traded funds are your first step so that you can live through the joys and the slumps of Nifty 50 and see whether you like the ride or no, right? So that is ETF. So we will look at a few ETFs, and also in terms of studying these products, right? ETFs are much easier to study because all you need to see is how much are they charging you, how well are they mirroring the Nifty. Only these two aspects you can look at and you can start investing in an ETF. But if it is an active mutual fund, now, not only will your costs matter, not only will your profits matter in terms of beating the Nifty, it will also matter in terms of the downtrends, right? So what if the Nifty is down? Is it able to hold stable or is it falling even beyond the Nifty 50, right? So you need to track a whole lot of factors when you actively choose a mutual fund. But choosing an ETF is much more easier. That's the key takeaway here. Moving on to the next product, National Pension Scheme. I really wanted to highlight the National Pension Scheme as a popular and a in-trend product as of now because the government is currently promoting it with even the new regime. It's one of the few products where you get tax deductions even in the new tax regime, which means that deductions here, especially by your employer, are deductible just like PF, right? PF, you had deductions for up to 12%, etc. in the old way of doing tax. Now with the National Pension Scheme, you get that for up to 14% of your basic salary. So there are good tax benefits here. Also, this is a very unique product because this is a product which is not just a debt product from the government, but also gives you equity exposure. You have active versus passive choices. You can choose if you want to invest more in equity via this product or less in equity. You have a lot of choices to do there. The only thing about this product is that it is a retirement product and therefore your funds are locked in until you're 60, after which you can withdraw 60% lump sum and 40% you're still asked to get a annuity product, which means it will pay out like a pension over your retirement period. That is what NPS is. We can discuss more, we can address questions there as well. But it's one of those good products in the market, and therefore I wanted to take a couple of minutes to talk in detail about it. Unit-linked insurance plans, these are disguised as we will protect your money, also give you life insurance at the same time. It will give you market returns, right? So these are a managed product which a lot of banks, we are all approached with these products. And I want you to identify from today that insurance plus investment is something which is neither here nor there. You should always buy a term insurance, medical insurance separately, which is insurance product, not look at returns from there, and then invest consciously where you understand the risk and returns, because at the end of the day, this ULIP will not give you enough returns for the risk you're taking, because they are also offering you insurance and taking over some part of your life risk, right? So therefore, you tend to lose out on the returns in a ULIP. Of course, if you're thinking that I don't want to take an insurance, but I will make some money out of this, you will definitely make some money out of this. But even here, they were trying to disguise this and sell it as investments, but the government has brought in brought in a problem here for investors also, in the way that, these products would also not be taxable, because this was insurance money coming to you. And insurance payouts are not taxable in the country. That's how it used to be. But what the government realized is that insurance companies were making a lot of money using this product and charging higher premiums as well. So if you pay a premium of more than 5 lakhs on a product that is ULIP, which is insurance plus investment, today you will get taxed as a capital gain, and it is as good as an investment from the government's perspective when you go through tax. Right. So therefore, again, it will kill any benefits that it gave you previously. At least there was some tax benefit, even if it gave you less returns in the past. But currently, that also will not happen if you pay these huge premiums in the guise of insurance with investment sort of a product, right? Now, I want to understand, amidst our participants, is there CA Shailja here? CA Shailja is supposed to be our guest speaker, surprise guest speaker for the session. Is she around?
Yes, I'm here,
Great,
Rashmi.
Shailja. So if you can talk us through the HNIs and ultra HNI options. I've, of course, mentioned on the slide that there are PMSs, alternate investment funds, but I will stop sharing my screen and you can take over.
Yeah, sure. I would love to do it. Can you allow me to share my screen once?
Yeah, sure, you can. The option is there. Just share. It should be there. This is so amazing. Wow, we have a guest star here. So while she shares her screen, I want all of you to take a deep breath in. We are absorbing a lot of knowledge. I'm taking notes and all of this. So let's take a minute. Today, we don't have to achieve a lot of milestones and get 100% of this. Today is our first trailer. Enjoy it like a movie. Go through the movie, watch it. We'll share the recording with you. Now we are going to a new section, HNI and all of this. So take a deep breath, all of you. Yes, let's do this with me. Hydrate, take a sip of water. And we'll see Rashmi in a while. Let's get on to Shalja. Thank you so much for taking the time here and coming here and sharing. Yes.
Hi, everybody. So you all have by now known have a idea of like what is a uh, a knowledge fund means, how mutual fund is works. So there is a new product, I would say, in the market which is very less known, because firstly, because the entry point in these regulated funds is for the high ticket end users. So here AIF is a similar concept as of the mutual fund. Okay, but the only main issue here is that your money gets blocked for the longer period, and here investors can only be HNI. So if you have like net worth of more than 3 to 4 CR, then it is advisable to invest in the AIF and hear more about what I am going to explain in detail. I know we are right currently on the stage of understanding the investment and finances, but yes, you must be aware of this topic, like the alternative investment fund, which is similar to mutual fund investments. Okay, so you must be knowing, like in our 90s era, you must have heard about Vikas Patrika or some kind of a non-regulated fund. Most of them have, taken money out from the people and they have never came back. Means this has happened to me and my known people. So at that time, the money, the corporatization of money has happened earlier as well, but there was no regulation. So in 2012, the Indian regulator, SEBI, who looks after the stock exchanges, stock market, and everything, they came up with a regulation called as Alternative Investment Fund. Means SEBI now regulates such funds where you being an HNI. Now, HNI, who are HNIs? Uh, is there any question on like who are HNIs? High net worth individuals. Okay, high net worth individuals and family office owners. These are set of people among us who have high um, high power of investing some anywhere. Okay, so this product is basically for them, and so their risk appetite is also higher in terms of mutual fund and everything, because in mutual fund we can start with 10 rupees investment as well, but here the investment point will
Chandra,
start
one
from
minute,
1
1
CR.
minute. I'm so sorry to disturb you, but the alternative investment slide is only open. Your slide number 4 we can't see. Only the
Okay.
title slide is available. Yeah, now we can see. So now if you
Okay.
click on the full screen, yes, all this we were not able to see so far. Can you click on this full screen down below? Go to bottom. Yeah, right next to that. Reading view, next one, slideshow. Yeah, now we can see the full screen. All of you can see the full screen, guys? Okay, lovely. All of you are HNIs in my opinion. All of you are great.
Yeah, we are soon going to
All
be, if
are
not.
HNIs.
Yeah. So that is why it is important to at least know this topic. Uh, yeah. So where were I? Where were me? Okay. So why this AIF exists? Yeah. So earlier also the corporatization was there, but these were not regulated. So those who have high risk appetite and high net worth, they can invest in the SEBI regulated alternative investment fund, which is similar to mutual funds. How this AIF works, this is I'm going to explain. Like the investors here means the HNIs, high net worth individual family offices who have more risk appetite and also the high net worth. They reach out to some fund managers. Now, who are the fund managers that I'll tell you? In short, I can say that these are like you can say Rashmi D'Souza, suppose, who has a 5 year or 10 years of background in investments and all. So she, suppose, for example, she has opened up a entity named as an AIF. There, AI, the manager means Rashmi can pull out the money from all the HNIs, and then the money pooled is invested into the securities. Now, here, what kind of securities it is? Mostly AIFs are risky products. Why? Because they are not listed on the stock exchanges. Okay, that means these are the companies, the investment here are made in smaller companies which are not yet listed in the market, and also they have just started up with their workings, like if they are in planning stage, or like from seed. If in this investment perspective, we can say, we can outline them as like seed stage companies, growing companies, and then matured companies. So earlier there was no such categorization. Now, to give impetus to startup India mission here, the government has come up with this AIF regulation where the pooled money is invested into the unlisted securities. So for in this investment, you don't have to look after the stock market work, how the stock market is working. It will be rather more placing more reliance on the fund managers. Okay, then your money, invested money, gets into the securities, and then fund managers will put their strategies, like in what area they should invest your funds. These will be outlined in a offer document. So before investing, you will get an offer document where you can understand where your pooled money are going to be invested, and at what time the exit will happen, what rate of returns you will get on from this investment, and at last you will get the money. But whole this process in AIF takes around 10 years, approximately 8 to 10 years. But ultimately, it depends on the manager, like how long they want to run the fund. But majorly, it is 8 to 10 years. So the major drawback here is the timeline for which your money gets stuck into this kind of investment, whereas we have mutual fund where money can be easily flown out. So this was how the AIF was working. Is AIF works, and AIFs, just like if suppose while investing in AIF, you also want to get a taste of stock market, then you can invest into the third categories of AIFs. AIFs are broadly based into three categories. So I'll quickly go through these categories. Firstly, why I've taken this one, because just Rashmi has explained about the stock market, and we have now got a good detail about how stock market and everything works. And as Rashmi was saying that suppose if you don't want to get into the details and understanding of all, like how the this fluctuations works, and don't want to read the fundamentals and everything, then you put your reliance on some kind of fund managers who run the show for you. Okay, so these the category 3 managers majorly invest into the stock market. So here, by investing here, you can get a good taste of stock markets. Category 2 is a little uh, balanced kind of category where you get your money will be invested into real estate funds, private equity funds, where the companies which are in their later stage of development, your money will be put there, or in the distressed. Now what is distressed are such kind of companies which have gone into uh, rehabilitation, you can say, which are going into rehabilitation. So your money will be a little bit secured here. And this AIF category first is a bit risky thing. Why? Because these kind of means the AIF category 1 invest into startups, and all early stage investments happen here, where the startups are into their planning stage. So how the company will grow, still they don't have answer to it. So, as Rashmi has explained, your return is based on the return risk you want to accept. That is based on your risk appetite. So here the risk appetite is more. Here it is a bit balanced one, and here you can see in the market, like it will be as per the markets. So your risk is a bit managed. These are the kind of categories of AIFs. Now, suppose if we are given to choose, like what criteria we should see while choosing an AIF. So these are the criteria. I'll quickly go through one by one. So first one is, sorry, actually the first one should be the fund manager. The fund manager, as I said, it depends on their experiences and expertise and their track record of like how in past they have generated the returns from the investments. So based on that, you can decide on your investment, their investment strategies. So you can match it up with your like kind of your investment focus, like you want to go and invest in some MSMEs only, or in some small cap companies, in some large cap companies. So based on that, you can select the respective AIFs. Third criteria is the fee. As previously explained by Rashmi, that whenever you are putting reliance on somebody, then that person is going to charge you some fee. That fee here in AIF industry is called as management fee. Okay, so whatever you commit to, invest in the AIFs, the managers charge a percentage of fee like 1% or 0.5%. This will be charged for whole year, for whole life of the AIF. That is for 8 to 10 years. And if suppose they outperform from their benchmark percentage of return, then they will charge you a little fee named as performance fee. So this is the tricky proposition here. Why? Because it is structured you know, uh, in a way that benefits you as well, plus the managers, because of their hard work, they have given good returns. That is why they'll be charging some point of returns from you, from your money only. Next is the risk return profile, like your risk appetite. If you don't want to get into the risky propositions, then MF, that is mutual fund, and FD is always a good bet. Otherwise, AIF are a good options. And next portion is the exit strategy. So if you want to keep your money intact at a place like for 8 to 10 years, your investment horizon is long, then you can opt for AIF investment. Otherwise, it is not advisable. Yeah, and this next factor is my favorite one. Why? Because here you get an opportunity. The co-investment opportunity is the one where you will be asked to invest simultaneously along with the managers. So if suppose you don't have any knowledge about how investment works, but still you find you believe, you have belief in the investee companies, like wherever your money is getting invested, startups or venture capitals, like, or private equity firms, then if you feel that yes, you can earn a money on your own self, just by interacting with the owners of the company, then the manager can give you this co-investment opportunity, of course at some fee, but your return will not be marked with performance fee plus a management fee. It will be a just one time fee that they will charge, and you'll get return directly from the company as you earn from uh, equity investments in the stock market. You will be called as an owner of the of you know of that company in some sense, to extent of that percentage. And at last, the AIFs considering factor is always, we ask in our networking group that whether it is good or not. So for that, SEBI has recently came out with this benchmarking thing, where benchmarking reports are being displayed for the AIFs to select like which AIF is good, currently doing good in the market or not. So this is overall like structure of how AI works. If suppose, uh, Rashmi, do we have more time? Like, should I explain here more about the life cycle of AIFs?
Guys,
Or should
vote
we start with the
votes for
Q&A
Shailja.
session?
Yeah, we'll just get into the Q&A because this might be interested to a small segment of this. You can take them further. If they are interested, they'll ping you and get to know.
Yeah.
That
Okay.
would be the
So,
best way. If they want to learn more, you could tell them how to reach out to you and you could explain to them in detail there.
yeah, surely. So at the end of this session, I'll put my details over here, and anybody interested in AIF investment then, or want to learn about AIFs, then they can surely reach out to me. And just to give a intro about me, as I skipped in initially. So I actively work in setting up the AIFs in India, and also help in running the AIFs. Okay. So if there are any work from home ladies, I run a consultancy firm which is purely a work from home concept. So if anybody wants to, come with us and, earn from this consultancy which I am running, then also you are surely welcome. And I'll share my number with Rashmi over at the end of the session.
Shalja, you
Now,
can drop
over to
your
you.
contacts in the DM
Yeah.
and
Thank you so much, Shanta. Just drop your details in the chat here. I'm sure there will be many who will be doing it. Maybe we can do a follow-up session later in much depth of this. And that was really very insightful. I also take notes. I learned a very new concept. So can we have an arigato for Shalja here in the chat and also for Rashmi, guys? Wow. So all of you guys, can we start with this? A note of gratitude in the chat box. Thank you, thank you, thank you. Now here is it. Now we're getting into the second part, which is going to be more important, I would say, because now we are going to recollect and put. We have learned a lot. Now we are going to put shapes, and Rashmi has taken time to answer some questions. But before we go that, I'm going to give you 2 minutes of bio break. I know because I could not go to the washroom during this entire session. I was, glued to the seat and doing it. So I'm going to give you a 2 minutes of break to refresh yourself, to wash your face. Think of it as एक period khatam ho gaya, tan 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 tan. This entire session took me back to my MBA at IIM Shillong days when I was sitting in it, and I had only two finance classes. One was behavioral. That teacher loved me and it was amazing. The other was slightly, complex with all of this and all. So I would sit in the class completely lost. And like I wanted to learn, I wanted to get in as much information as I had, but somewhere I was losing. And then I started questioning myself, ki yaar main sahi to kar rahi hu and all of it. But that time I did not have such an amazing teacher as Rashmi. And today I learned so much, even though I do investing and I'm handling a company and all, but there was just so much to learn from both these lovely ladies. And today, after this break, how many of you can relate to me going back to the college days now when one subject, very interesting subject is going, but बहुत कुछ हो रहा है, how to grasp all of this? Yes? How many of you felt this? Yes? So as you could have understood, first, one session is not enough to understand all of this. So we will be doing a series of sessions with them to explain. But after this call, after this, we had such an amazing discussion, so many things. I'm going to give you 2 minutes of break and then I'm going to show you how after a class, how do I make my notes? How do I prepare everything so that I can maximize what all I've learned? Would you like to, of course, I'll use AI to do it. Yes. So I'll take you 10 minutes to show you how to recap and revise all of this again. And then we will have a Q&A session with Rashmi. I would say as long as you have doubts and all, let's see how long it does. So cool. So I'm giving you 2 minutes of break right now. Wash your face, come prepared. Class 2 is starting in your period 2. Now back to this adulting college, we are going to learn about how to use all this, how, and we get into a Q&A. Okay? The only time I've ever used my mom's passing away as an excuse has been in my finance exams. I was so weak at it, and more than weak, I was so scared to start it. I have taken tougher subjects and been able to get through all of them, but I was so just in my head, I had made the problem seem much bigger. कि इन्वेस्टिंग बहुत बड़ी चीज है, फिनेंस बहुत बड़ी चीज है, मैं तो इंजीनियरिंग बैकग्राउंड हूँ, मैं तो क्रिएटिव हूँ. I never had this kind of support, the kind of, I tell you, even from an IIM, I paid 25 lakhs. But the kind of teaching, the kind of simplification is happening right now, amazing. Okay. So when you come back, 3 minutes, I'm giving you a break. Please be here. Come back with your wallet as well. Okay. No, I'm not asking you to pay me right now, but we'll start this transition. Okay. Okay, let's go. I'm setting up a timer for all of you.
Hi, Sanchari. Can I just say something?
Yeah.
Hi, Sanchari, it's Vandita. Can I say something?
Yeah, Vandita, sure.
Hi, I'm really thankful to you for this session and to, of course, our great speaker, both our speakers, Rashmi and Shelja. I completely resonate with you. You know, I have completed a course of entrepreneurship from IIM Bangalore, and believe me, I haven't learned so much in that entire course, so much that I learned in this class, and it's so insightful. And I'm going to listen to this recording at least 2 times so that I can make comprehensive notes on that. And I didn't lose a minute when Rashmi was saying all these things. There's so much to learn, and in such a lucid manner, in such a beautiful manner. I don't know how to explain it. Thank you for having both of these panelists on board. Thank you so much.
That's it. Thank you so much. So, Vandita, you can have join when you join in, have your breakfast while listening. The next part of it, I'm just going to show you a couple of things and revise. So, all of you can grab a snack and do this. I'm giving you 3 minutes. That's why catch up on your bio break, get a snack, come back, and let's continue this. Today, this money thing we are going to resolve now and then. Okay, quickly go in. All right. So I first of all want to know how many of you are still here. How many of you are the true money makers who want to get more money in life? How many of you are still here? So today, as you can see, we are all about learning about money. We are all doing it. So before we start this next section, all of this, whenever we learn, is connected to AI and energy. I want you to take your wallet in your hand. We express gratitude to Rashmi. We express gratitude to everything. Today, let's express gratitude to the main character in this story, which is, who is the main character? ये सब हम क्यों कर रहे हैं? Only 2 people are here. How many of you are here?
Wallet.
This ritual starting, I at least need 11 people. Yes. Who are the 11 people here? Ritual. I want at least 11 people here who are here, who are here. Who are here? Yes, yes, quickly. I'll then only start. I can wait. भूख लगी है ना तो जल्दी जल्दी क्लास करना है. Okay. So we'll start with the small ritual of doing arigato to money first. Today you have learned, you have opened, think of this, Rashmi and all have opened a new portal for you where you can multiply your wealth on the go. These concepts and all which you might have heard people say, they are doing it. So your relationship with money has now increased. Introduction of rupee smart drive in your life has bought in more rupees, made you more smart and got that drive in your life. So quickly grab your wallets. Take it at the center of your chest, your heart. And I want you to say, I love you, money. I want you, money. Money is my BFF. I love watching you grow, money. I like taking risks with money. I invest my money. And give your wallet a small little kiss. And arigato. Again, arigato to RSD, to Rashmi, all of you all for helping. So dekho, now after this is coming the Q&A session when Rashmi will take you, but I'm going to take you 10 minutes to show you how a person like me, when so much information is done, how do they compose it and learn more? Would you like to know कि आज के information का how can you make the most of what you have learned today? Yes, can I take 10 minutes to show you? Yes, okay. So of course, I will be taking the help of my favorite tool called ChatGPT. So now understand, today we learned a lot of terms. Some, of course, Rashmi will solve. Some of you might be feeling very shy to ask, or you might not be able to even, what do you say, ask it anywhere. You could find it in Google. एक वे होता है तुम Google चले जाओ and Google से वो term समझो, or you go to YouTube, or you understand through that. That is one way. Or the other way is, for example, I took a screenshot of what RSD was telling. Now I can ask it, explain this to me. So Rashmi has set up a framework for me, which I am able to understand. So I just took a screenshot from this. And from here, I have found out this, okay? Now maybe this is a little too complex for me. So I will say, explain this to me like a 18-year-old. Chalo, 18-year-old is still good enough. Okay, you can even simplify. If you don't understand this, you can put a 15-year-old. So see, it's given me an example. Your primary market is you are at a concert and the artist is selling tickets directly to fans for the first time. The company is saying, hey, we need money to grow. Want to be part of our company? Okay, now similarly, explain one word that many of you were asking me also, dividends. Similarly, so think of it like a pizza. Let's say a company makes a big pizza of profit. Now, since you own a slice of the company, then give you a small piece of that pizza. That's your dividend. So no more shares, more pizza slices, more dividends. Got it? Easy. So now these things you can play in audio. You can ask it to explain to you in Hindi. Maybe in regional, you say explain in Hindi, like, let's say, even you can add in so much into there, like Navjot Singh Sidhu, if you want to understand through him. So now when you know, when you're familiar with these terms, she has taken you beautifully through it, start asking this. And this is how I start learning. Now, similarly, say, okay, it's put out there, see. So in regional also, you can generate all of this and learn, because sometimes mother tongue can help you learn more.
सिद्धू स्टाइल में समझते हैं, स्टाइल तड़का और तुकमदी के साथ। डिविडेंड क्या होता है? जिस कंपनी में तूने पैसा लगाया, उसने मुनाफा कमाया और तुझे भी हिस्सा दिलाया। जब तू किसी कंपनी का
So this is also the big decisions. Of course, you will ask Rashmi, if I have 1 lakh rupees, how should I invest? But say she tells you कि आप ETF करो. How do I know what is an ETF? So I will ask, what is an ETF? Explain to me, like a 18-year-old, and give me pros and cons. तो देखो अब तुमको जो वर्ड नहीं समझ आ रहा, एनी वर्ड, फॉर एग्जाम्पल व्हाट इज निफ्टी 50, नाउ आई कैन आस्क इट व्हाट इज निफ्टी 50. It doesn't judge, it doesn't get tired. You can change it, you can ask it, you can even say in between, I am getting very demotivated. This is all too tough. Besides, I don't have that much money to invest. I give up. Relatable, relatable. Yes. How many of you are relating to this? Relatable? And then I'll just ask it, ki, bhai, you solve my problem here. Take a deep breath. You are not alone. Feeling overwhelmed in the beginning is completely normal. And you're not failing. You are just starting. And see? Whew. Yes, so that's how I enhance my learning and doing it. When I teach you journaling, and how many of you had a wow moment like this, that this is going to put my so much learning into this? Yes. So anything you learn now, if you have taken screenshots from it, you can add. Now, one more step you can take this further is you can start saving these responses. So whatever you learned today, for example, let's say I will show you, I'm not getting into detail of it. Next month, Impact Max, when we start, we are going to do this in much detail. I'm going to show you this notebook in much detail. I'm just showing you how much you can do into it. So 1 minute. So for example, this is notebook.lm, which you can use to learn anything about this. For example, you want to learn ETF. What are bonds? Okay. So now you see this is a 15-minute video. By the way, I watch these videos only and learn, and that's why and nobody has ever, been able to talk about topics like Rashmi. So that's where when I saw ki this is so nice she does, I asked her to teach all of you as well. So here I have put this link and just watch. I have got this entire, all the notes and all of it here. Now see, I can start asking it questions as well. Any kind of question. For example, look at this. So I have fed into this and learned about the knowledge, and now I can learn about this, all of it through. I can say, explain in one line. Itna kaun padega? Super cool. So now you can use this for learning, but again, this is not a substitute for human intervention. You will need a coach. These terms, how to understand, you do, and then you come to the expert, and that's what you do. I learned social media. Now I have a social media person to run this, but I know what to ask. So now with all this knowledge, you can go up to her and ask her, how do I take this further? How do I increase my returns? Cool. Let's go. So use this well, guys. Today also after the session, watch it again. It's already there on YouTube. I'll share the link. एक एक term को समझो. Dividend, yield क्या होता है? If you don't understand what is a holding period, what is a lock-in period, what is the difference between hold-in and lock-in? Start from the really basics. For example, very honestly, credit, salary credited versus debited. Yes. What is credited, what is debited, all these basic terms. Now you don't have to be embarrassed about it. You ask me, you ask Meta, you ask the community. Superb. So let's go on now to ask. We'll now take over. I know मैं तो ऐसे आती रहती हूँ, but today is all about asking all your basics, everything from Rashmi, and she'll tell you also how to take this journey further. We had said that we'll do taxation also in it, but I feel that this session is already a little taxing now. We have learned a lot of numbers. What do you think? Can we do the taxation in a separate session? So that today you focus more on this, and then is it okay? Please comment in okay. If you, I personally think we'll be able to give it more energy and fresh, absorb it today. Let's get on to investing. Okay, super. Cool. I know March आ रहा है tax का वगैरह है, तो I think it needs a little more this. So Rashmi, are you there? Let us talk more about let's take all of your doubts. पहले तो of course doubts होने के लिए doubts होने भी चाहिए, पूछने भी चाहिए. तो ये वाला part सिर्फ रश्मि नहीं बोलेगी. We want it to be interactive. Ask your questions, ask your doubts, and go for it.
Absolutely. Let's go. Ready for the first question?
How are you available today? Where is Rian?
My husband is with him.
Oh, he's taking care. Wow, very nice.
Right.
You're here.
Let me quickly put up my slide with my contacts. I think that might help everyone get in touch with me after this session as well, and reach out if you have any specific questions you don't want to talk about here. I will just put up that slide, and you can continue to put your questions in the chat box, and we'll look at that as well, right? Okay.
Yeah.
So
Sanchari, may I ask one question from me? I don't know why my raise hand is not coming. I'm sorry, I'm just speaking without raising my hand.
I can't see who is asking or saying.
It's
Vandita.
Vandita. Yeah, Vandita. Sorry, my raised hand was not coming. So sorry, I had to really speak up before raising my hand.
No worries, you just ask. कोई issue नहीं है. Ask now.
Yeah, thank you so much. Rashmi, so far, see, my journey went from being a microbiologist to venturing into artpreneurship, right? So I have my Mirai Creations India, and I have pitched that also in one of the courses which I took in IIM Bangalore. I think it is always fortunate that you don't get selected, and I also get that from Niranjan because he complimented me for not getting selected, and Sanchari also has been really my support. But more importantly, there were many terms which I have understood here with your session. Most importantly, which I want to ask here, that I projected myself as an LLP there. So, what is the difference, or what is the benefit of projecting yourself as an LLP or as a private limited? Thank you so much.
Right. Okay. So, limited liability partnership versus a private limited company. So, of course, a limited liability partnership is limiting your liability in terms of the business and keeping your assets and liabilities as Vandita separate, right? So, that is the reason you create an LLP in the first place. Let me start with that. But as you become a private limited company, that is like your next stage. Let's look at it that way for the purpose of this discussion. If you're expanding and going into the private limited company space and becoming one, you have more access to funds in terms of the number of shareholders you can have, the more in terms of also the accessibility to saying things like reaching out to these private equity firms, venture capital, etc., rather than being a limited liability partnership. Because as a limited liability partnership, people are only looking to place their faith on you as a person, despite you having created that as an entity. A private limited company is more seen as a independent entity in the business space, and therefore gives you better opportunities, better access to funds from an investing standpoint, of course, but also invites more compliances and more formalities from your side to meet. So you should actually take that step only when you're ready to really expand and you have that need for funds, or you need to kind of build this perception of your business as a very separate entity, has its own space. So for example, today, let's say Rupee Smart Drive is very synonymous with Rashmi Shenoy D'Souza. Tomorrow, I want Rupee Smart Drive to have a legacy of its own and not necessarily be identified with Rashmi Shenoy D'Souza. And that is the day, a private limited company will make more sense in terms of scale and building it up, etc. Right? So that's the sort of perceptionary difference, investing difference, and also compliance, like I said.
Great,
Hope
great.
that
Thank you.
answers. I'm sure it's not a very exhaustive answer because I'm
It
not,
is not.
what do you say, practically into these two spaces, and therefore wouldn't have all the aspects covered here. But from what I know from an investing angle is what I have put out there.
No, thank you very much. No, I honestly, what I learned from I am Bangalore, your lecture today is definitely a step ahead of that. So definitely will
Wow,
support my
that's
knowledge.
that's a big
So
thing to say. Thank you so much.
no, thank you. See, coming as a microbiologist, it would have been a dream cherished if I would have got incubated in I am Bangalore. But I know, of course, I need to learn more. So I'm just learning on the go, and let's see what future in stores for me. Thank you so much.
Thank you. Absolutely. I think I want to make my content accessible and understandable for especially those people who come from non-commerce backgrounds like yourself, and simplify it for them. That's the target, and I'm glad it's met today. The next question, let's start with what's on chat. Which is better to invest, gold or gold bonds? I think I'll start with that. Juhi has asked this question, and you mean physical gold or gold bonds is what I'm taking it to be. Gold bonds were sovereign gold bonds. Presently, that's the only gold bond that we have in the context of talking as a bond. You can still invest in digital gold. That is a third avenue, which is not in your question, but I will talk about that as well, because physical gold versus gold bond versus digital gold is the actual comprehensive question here and the discussion. Physical gold, if you hold it in terms of, let's say, gold coins, biscuits, etc., eventually, if you want to make it into jewelry and stuff, you will lose a lot in terms of making charges, wastage, etc. So all the returns that you've gained probably will have this leakage aspect, and therefore physical gold is not recommended because of this, unless you are wanting to really make jewelry and that is the reason you are accumulating gold, right? So then it kind of knocks off and makes sense, because jewelry is your goal, not investment and returns. If you're talking about gold bonds, so the only gold bonds we are in this context talking about is the sovereign gold bonds that the government used to issue. Has stopped fresh issue, but it is available in the market, in the stock exchanges, etc. You can pick it off the market. So these gold bonds came in with the eight-year lock-in. The interest payable, they also used to pay an interest on this every year at 2.5%, and that was taxable, of course. But the way the gold has appreciated and the amount the government has had to spend on this bond, they have now discontinued it. And therefore, it's no longer that lucrative place. But then, of course, if you believe in the growth of gold as an asset class in terms of price, even in the coming years, then definitely you can pick it off the market. But when you pick it off in market, it's also about looking at that undervalued, overvalued piece that we discussed earlier, right? So that is the application you need to do, because market prices will not be like the issue price, which, the government used to do. Here right now, the demand for gold is quite a bit, because the current trend, what we are seeing is most governments, most countries, everyone is swinging more towards gold than investing in markets and equity, etc. So the gold prices are going up and the demand is higher. So you will have to analyze if that price of SGB is still lucrative for you to buy. But if you believe in gold as an asset class, you should go for it. If you believe in gold as an asset class, the other avenues for you are digital gold, right? When I say digital gold, this is like that gold vault that I mentioned in Google a while ago. You have options like Gullak Gold, etc., through It's a Swiggy promoted venture, and also, I mean, it's advertised on Swiggy. I don't know if Swiggy promotes it though. So these are the new age investing form of gold where it is all digital. For example, Gulag Gold will buy gold for you in terms of whatever amount of money you invest in them. They will lease that out to actual gold jewelry companies and makers. So, for example, a Tanishq, a Malabar, or whatever, and they will pay you an interest because for these companies, gold is actually just a input and processing material, right? It's not an asset for businesses. So they will use it and they will do whatever with it, and they are paying this particular platform, which is Gulak, and Gulak is paying you. So there are lock-ins involved. There is a certain percentage of interest that's paid out. So these are different combinations of products that are available in the digital gold space, which you can explore. So if you want exposure to gold as an asset class, these are all the avenues. But if you are looking to make gold accumulations, and you are looking to collect gold because you want to, eventually have jewelry or whatever, physical gold matters, then of course physical gold is the way to go.
Okay.
I hope that answers, Julie.
Yeah, it's quite clear.
Thank
But
you.
this Paytm and all, they also have this thing where we can buy gold bonds and all.
Similar to Google Pay, like I said. So everything is now called a gold vault sort of a thing, where they are buying and accumulating. They have vaults with whatever, just like banks handle cash ATMs and all of that,
It's
right? There
safe
is,
to
yeah,
buy
so
through them.
pretty safe. Yeah.
Okay, thank you.
Thank you. All right. Okay. Then next question I see there is Dr. Jury asking about NPS. As a government employee, I'm under NPS scheme. NPS, you mentioned different. So no, NPS is available to government employees and all of us who are non-government employees and non-employees also. So it's a pension product basically, which is promoted by the government, and it's accessible for everyone. Government employees used to get higher deductions and better deductions even in the past, but currently it has been made more attractive for everyone. And that is the reason I brought it up in this session. And moving on to the next question. Samina, goal-based investing, right? So goal-based investing is a topic that I wanted to cover today. In terms of a few slides as well I had. We can do that as a complete exercise, but if all of you want to quickly participate in an activity, we can do it that way too. Let's have an activity. Can we have a show of hands for who's interested, or do you want to continue with Q&A? Okay. All right, I see a couple of votes. Cool. Activity. The vote for activity. 2 people have voted. I'm going with the 2 people because the rest are kind of, I'll take that as neutral. We can go with anything, right? Let's go with this activity. I will put my slides up on display if needed for this activity. Otherwise, let's just do it free flow. Okay, so we started off with a must-have protect of emergency fund, right? So if I want to keep an emergency fund worth 3 months of my expenses, which product do you think I should invest in? What are your different thoughts? What should that product be? Should it be liquid? Should it be stable? Should it be growing? What should be my? It's also a quick revision, in fact, if we do it this way, because we haven't done a revision of the session and we've missed a few slides. So this will kind of round it up well. Let me see some answers. Okay, liquid but growing, ambitious, growing. Okay, okay. Right. So this is where, you know, the actual focus should not be on growth, but on stability and liquidity. Growth should be focused on, but not in the way that you want aggressive growth. Stability and liquidity is your focus, because ultimately when you need the money, you should be able to access how much you have kept there, and without losing too much money over getting that money, right? If that sounded right. So where would you keep it? Not in the equity market, because like we can see, we have a current fall. So if you go into the equity markets, right? So last September was a top, where the markets were at the top all-time lifetime high. And right now we are at a 10% fall. So let's say you were at your worst luck times and you invested right at the peak of the market in September. and that is your emergency fund, today you will get only the 90,000 for the 1 lakh you invested. Simply put, it doesn't matter which share. I'm not going into the details there. So would you want to have that scenario in your life for your emergency fund? I guess no. You would want to get, if you put 1 lakh, at least something like a 1 lakh 10,000, or if nothing, at least 1 lakh 5,000, 1 lakh, right? Nothing less than 1 lakh. So for that, what would you do? You would go in for something like an FD, something like an RD, something which keeps your money safe, at the same time gives you reasonable growth. So the safest investments in this space we've seen is more like the fixed deposits in all those spaces, right? If you're willing to take that little bit more risk, for those of you who are opting for growth even in an emergency fund, good luck to you with the small finance bank deposits that pay you 9.5% interest, right? And this will be constant. But again, you would have to check the terms, whether the lock-in will cost you something, whether exiting it before the lock-in will actually impact you or something like that. So this was an example with emergency funds. What if you are putting together a corpus? Corpus, when I say, is a accumulation of money, and you're investing for the sake of your child's higher education. Your child is, let's say, right now 10 years old. So you're looking for higher education at, let's say, the age of 18, when probably your child will want to pursue something abroad, a professional course that is going to cost you in lakhs. What is it that you will opt for? Some answers? Okay, mutual funds. What sort of mutual funds? Debt, equity? Is there any ratio that you will do? Is there any split up that you want to do with this? So here you're looking for growth more than stability, liquidity, right?
Maitri, you two were there also in Rashmi's special session when she had taught about parenting budgets and all that. Itself was such a nice session. If you guys had attended that, how to set up a parenting budget by Rashmi, so you should know.
I think so,
All
but I think
right.
it's gone out of my mind now.
No problem, Maitri. I wanted to, in fact, cover this in detail in terms of long-term goals, not just in terms of parenting goals, right? So this is a more comprehensive session that we are here, and doing this in terms of applicability and understandable to everyone. So for any long-term goal, let's say, which is beyond 5 years, right? 5 to 10 years is your time frame. This is what is called a long-term goal in general investing terms, or for the purpose of this discussion, let's say. Anything that you're looking for beyond 5 years, you can go on more exposure in the equity markets, because in the equity markets, eventually over a 10-year period, you will have good returns. You will have returns close to 10, 11, 12%. That's the average that's been seen, despite all of us looking at equity markets in the reverse sense, where we think that you will get in for, a day, a week, 6 months, and you will make lots of money. That is possible only from a trading angle. From an investing angle, that is possible when you are in the bull run, and bull run is when the market is always going up, and more or less the trend is up, and demand is always exceeding supply. This is where we were in the markets in the last 3-4 years. But that is not the true story all the time, right? Markets will have corrections. They'll come back to their original valuations, like we've seen. So a bad downtrend or a bear run, what we say, could last for a long time. Let's say even 3-4 years at its worst, or even more, 5-6 years. And therefore, we say only money that you are willing to forget about, completely willing to forget about and not even see for 5 to 10 years, beyond 5 years, and you will need it only after 5 years, 10 years, whatever. Those are your long-term goals, and that's where you will invest, let's say, up to 60, 70%. And the best way to do this, a thumb rule to do this, is to do your 100 minus age rule. If your current age, let's say, is 35, maximum exposure to equity in your whole portfolio, in your entire investing basket of all sorts of investments that you hold, should be 100 minus 35, which is 65%, right? So this is like the thumb rule. You should apply to your entire basket, and especially to long-term investments, where you can go with that percentage. If you exceed that percentage, then you're taking risks beyond your age, so to speak, because traditionally, as you go towards your retirement age, you want more and more safer products, so that your retirement can be funded purely out of passive income, which is coming from all these products of investments that you're doing, if you're not able to work or not willing to work or whatever the reasons could be after retirement, right? You don't have an active income which is as big as as big as in the present, and therefore that is the traditional sense of retirement planning as well. So that is why the 100 minus age rule is the rule for equity exposure, and what you would also apply to long term investing, which is like a long term goal which is beyond 5 years. And so therefore, coming back to the question of children's education, right, you could do it that way. I think I've given you a couple of examples, and I again want to do more Q&A, of course, rather than start and introduce newer topics. So any more questions?
Okay, I actually have a question, Vandita, here again. When we're talking about large middle cap, how do we actually build a stable portfolio, and how do we recognize which would be good large caps to invest in given the funds in hand, and how to, align your portfolio with the goals which you have, investment goals that you have?
Right. So firstly, put together your goals, put a time frame against those, right? This is now, should I open an Excel sheet maybe to do this? Might be easier. And I could showcase what this looks like in the real situation, right? Okay. Right. Okay. So if my sheet is visible, let's just continue with that. Do we have the screen visible? Great. Okay. Sure. I'm just going to Okay, I'm just going to start off saying, okay, so if you have your short-term goals, long-term goals, I'm going to first say 1 to 3 years, something. So this is, let's say, and 3 to 5 is my medium term, and 5 to 10 years is my long-term goals. Let's just pick one example for simplicity. Let's just say emergency fund here, since we've already discussed that. Children's education, since we already discussed that. Medium term, let's say I want to buy a car, right? Now, the car I want to buy, put a present value of all of this. So, for example, emergency fund today, 6 months or 3 months worth of my expenses is, let's say, 1,50,000. So, I spend 50,000 every month. So, I want to make an emergency fund for 1,50,000. I want to buy a car which costs, let's say, 10 lakhs today, right? So, I'll put that. Children's education, like I said, in 10 years' time, I want to keep 1 CR aside, or let's say 50 lakhs aside, whatever, for my child's education. Now, you apply a rate of inflation to see what is the amount you will actually need in that many years. So it may not be very relevant for the emergency fund, but a car that costs 10 lakh today in 3 to 5 years may cost something else, right? So you're putting that and getting that value out here. And then the 5 to 10 years children's education, again, today it's something is costing 50 lakhs. So to send your child abroad today might look like 50 lakhs, might not look the same in 10 years time. So what is that amount? So let's say the rate of inflation for education is quite high currently. So I'll put, let's say 10%. It's not it's not 6% what we know. Buy a car, probably I might have a budget of 10 lakhs and I might buy a car which only costs 10 lakhs even after 5 years. Or I might put in, say, let's say a decent inflation of 5%. Okay. So whatever that comes out to be, let me not put anything here, right? Now, whatever this amount comes in, right? This is what you will use a goal-based SIP calculator and start investing in those ratios. So for example, we'll do the calculations, of course, just to showcase how to build your own financial plan. I do this for clients one-to-one, and it is a paid service. So I would like all of you to reach out to me if you want this done for you. At the same time, if you want a glimpse of what this looks like, we can get into the calculators and do it right now as well, just to see, just to get a feeler of what this feels like, right? So here I'm going to put debt, I'm going to put equity just to keep it simple, and say this is going to be fully 100% debt. For example, buy a car, I might do 30% equity and take the rest. Sorry, 30% equity here and 70% debt. This is just an example. These percentages are not sacrosanct. These are customized for every client. So this is all driven by your risk appetite of how much you are willing to bet on the markets, what is the current trend, etc., etc. So these percentages are driven with that. For children's education, like I said, applying that 100 minus age rule, let's say, I will go with 40% debt and 60% equity. Okay, so if it's a 40-year-old, I'm going to do it this way. So now, overall, when you see, overall, whatever amount you're getting here and the SIP you are coming to, that SIP or that amount which you have to invest every month has to go into products in this ratio. That's the overall logic of this template. So you do have calculators. I'll just quickly showcase a particular calculator portal that you are seeing, you can see, and you can explore this yourself. All right. So let me quickly put that portal up. Right. Yeah, I think you would have heard of this term in a lot of ads. Mutual fund sahi hai. So mutual fund sahi hai is one of those websites which gives you a lot of these calculators, right? So for example, we said goal SIP calculator. Now this is what I want people to use. So what you would do with this is, if your goal amount is this much and you're saying, you know, so for example, if you had to go back to that sheet, let's say buying a car was 10 lakhs, but with 5% hike, let's say it's costing me whatever. I just put a hypothetical figure, but you can calculate that. Let's say my budget after 5 years, I want it to be 15 lakhs. And that's what I want to accumulate in 5 years. My rate of return I will put based on the ratios that we've come up with for this, right? So if it's debt, you're getting, let's say 7% on FD, equity, you should kind of consider 12%. So the weighted average of that is what you would put here. And then when you say, so this is what it will look like. So monthly SIP amount is 3,000. So for the 5 years, and then your total investment will be, sorry, so I think I didn't click that button. Yeah, right. So for 5 years, you will have to put in 18,000 every month in that ratio of 30/70 that we discussed. And your investment will be 11 lakhs, but you will get 15 lakhs at that rate of return. And therefore, at 15 lakhs, you will be able to buy your dream car, right? So this is what it looks like. This is again a trailer, and I don't want to overwhelm you with too many calculators and numbers here. Um, that's how you would do an actual financial plan. Let me look at more questions here. When do you go for debt mutual funds? So debt mutual funds, you should compare the return of debt mutual funds versus FDs. There are certain seasons when the debt mutual funds pay out much more. But essentially, understand that debt mutual funds are only investing in the same debt products that are also available to you. Some may not be. And also, they will be charging you something. And the returns are more or less the same. So you will incur a cost for doing something you can do by yourself as well in a debt mutual fund. That is predominantly why it's not very popular. At the same time, it is a better option than FD if you're not willing to research into bonds and do these things yourself, right? So that's where debt mutual funds kind of fit in. Any other questions? Looks like I've complicated things more than simplified. A lot of you are
Rashmi,
overwhelmed, or do you have more questions?
sorry,
Ask
Rashmi,
me the
if
simple
I'm not
questions as well.
Uh, Rashmi, I was seeing, I let me like log in. I was logging through my phone. How about I make my first investment right now with you, and I have some 500 rupees extra from this. So I am logging on to Grow. You tell me where to put my 500 rupees in. Is there any way I can use this? देख 500 rupees का क्या करूं? या तो यहाँ
Okay.
जाएगा या स्विगी पे जाएगा, बताओ.
हाँ ठीक है. तो अभी आज के सेशन के हिसाब से पॉपुलर थिंग्स हैव बीन गोल्ड, बट माय वोट इज फॉर Nifty ETF, because I've been with Nifty ETF and have ridden the bull wave. If you can run a quick poll, Sanchari, for gold versus Nifty, and we can decide where to go. At the end of it, I'm taking a bet.
We'll just do A and B. A and B. We'll do A is gold, B is Nifty. Let's see.
Yeah.
Are women gold
Yes.
gold diggers, or are we Nifty?
Are we going to be always known to be digging gold, or should we go for Nifty today? So gold will be digital gold. Please don't imagine that you will buy gold and it will be physical and you will get delivery of a 1 gram gold coin or something. It's not that. We are going to showcase digital gold, of course, in this session.
But Rashmi, is it true that at any point of time I can ask the government ki I want my money, jitna mere paas money hai, utna you gold is, can I ask?
As
If
in, I
somebody,
didn't understand the question.
this
Sorry.
digital gold, at any point of time, can I go and ask the government, नहीं मुझे मेरा पैसा नहीं चाहिए, मुझे इसकी जगह इतना वर्थ का गोल्ड दो?
No. So digital gold in terms of the government's SGB, because you are saying government, I'm assuming that it is SGB. So that is a bond at the end of the day. So it is still a financial instrument. It's not a physical gold instrument, right? So digital gold can be physical only when you take delivery from places like this Gold Vault, etc., which I was talking about in Google Pay and things like that. But they are actually the hybrid versions. Essentially, we had only two, which was either physical or financial version, which is of gold. But now we have something of a hybrid where you can keep it digital, but the day you need physical, you can convert it into physical. That's
हाँ,
what
वही
these
मतलब we can
Paytm
get it
and Google
converted.
Vault are introducing and doing.
Okay. So how many of
Rashmi,
you
I want.
have an app in your phones, guys, which you can immediately do? Which are the apps that you suggested? Can you tell them, Rashmi, the name again?
Yes. So for investing, you could look at the current age platforms like Zerodha, Grow, Scriptbox. These are quite user friendly and cost efficient too. So these are some of the names that I have. Of course, I'm not promoting or anything, so I'm not going to take a lot of names as well. It's not that these guys have paid me either. So it's just an example
So those who do
of
not
what I
have
have
the
seen.
app, at least first step, you start with putting the app in this.
Right. So
First
when
step
we
where you guys
decided on this
download the.
class between Sanchari and me, since I have been investing for very long, I did not have a new age app also, and I tried with Grow, and Grow seemed to be very user friendly and easy. So I did my digital KYC sitting at home on a Sunday afternoon, and my account was up by Wednesday afternoon, and I could do my first investment by Wednesday. So that's really the turnaround time, and digital KYC is just uploading your PAN, Aadhaar, doing a bit of digital locker formalities on the app, and linking your UPI at the end so that there is an access to funds from your bank account to this account. So Grow is the portal that will host it, and you
So
will
this
be.
is the Grow portal, guys, and like she said, it's pretty easy. You set up in there and all. What I want all of you to see is once you download the app, thoda setup करने में time लगेगा, but you can see what is going on in the app even then. So now let's see. Okay, so I'll ask you only, Rashmi. I have 500 rupees. Where should I go into? Tell me, should I go into dashboard? Should I do into it?
Hit the search button. I
One second.
switch off my video. You can put your screen up to
One.
share, and it's easier to focus, I
I'm just
suppose.
spotlighting such that we are not visible. Okay. No, you can turn on your camera. It won't be issue. I am just putting it on screen. Okay, so all of you guys now with Rashmi, I'm sure many of you will be understanding a lot of these concepts like what is Nifty 50? What are these holdings? What are these large cap, mid cap, small cap? All these terms now you guys would be understanding also a little bit, and you can see stocks is where it is about again equity, mutual funds is there, UPI is there. So where do I go to? I'll search here, like she said. Yes, tell me.
Yes, hit the search button, look for, just type in ETF, and we'll see what comes up first. And then I'll help you along. Yeah. Okay. So Nippon India ETF, Gold Bs, Nifty 50 Bs. If you have 1,000 rupees, please put 500 each in both. That's what I would say, Sanchari, right now, because we didn't have a clear vote on which way to swing. But having done a bit of a study on this myself for a particular client last week, I have the top 3 names in both these categories, right? In terms of performance and what costs us very less. So what you can go for, let me just give you the
Mota
names.
moti, Rashmi, what are the things that you are looking into decide? Like I decide on the return.
So
Of
there is
course,
just
what
two
is the
things.
price and
You should go on this. Let me just type it in the chat box for everyone. You should go to this particular site called tickertape.in and look for ETFs, of course. So look for the um, expense ratios of these expense ratio. I'm just typing it out. Expense ratio plus tracking error. So what this means is expense ratio will tell you how expensive these funds are. So obviously you have to pick the cheapest, which gives you the best return. Tracking error means, see, these funds are supposed to mirror the actual price hike of gold or where the Nifty 50 is going, right? If they are not able to actually mirror and they deviate a lot, that is what is measured by tracking error. So essentially, both your expense ratio and tracking error needs to be sorted in terms of the ascending order and look at the best returns. Best returns, obviously, they'll give you more or less the same since they are ETFs and they are just mirroring what gold and Nifty are doing. You have to rank them by these two things and pick the best. So currently in the gold space, I think SBI Gold is doing very well, SBI Gold ETF. And for Nifty, let me give you the name.
okay. So from the app itself, we should not just rely, but we should go out and check on the ticker tape also. Okay, that's a
Yes,
new
ticker
one.
tape for these two factors, because on the app you will not see uh, the tracking error and cost. But again, this is only to fine to tune your investments.
By
If you
the
don't
way,
mind a slightly higher cost, but you want the returns mainly, then you can just go ahead with any of these ETFs, because most ETFs will perform the same way in terms of the returns. Might cost you fractionally slightly more or less, and that's what you're trying to do fine tuning with this sort of research
so
on ticker tape.
as you all can see, guys, I have already done Nifty Bees and Gold Bees. Both of them I have invested in it. You can see. So, of course, right now, for I've just see like I had 500 rupees, like I just said, right? Ki if I have 500 rupees, what should I do? Even though I've just put 542, guys, देखो ऐसे 50 रुपए भी तो extra आ ही रहे हैं, right? So these are whenever I have some of them, I keep adding on to it. This is just for an experiment I wanted to show you. This is my gold. Some of you were asking about sovereign gold bonds. These are my gold bonds. You the only let me show you the returns. So it's 43% and 72%. The only problem with this is it is good return, but for the next I think it is an 8 year period lock-in. So 8 year period lock-in I have for it. So that is what these are all these tools and all you can put into. So you can see small, some of it I have put in stocks and some of them I have put in mutual funds. So when remember Rashmi was saying in the beginning, chote sum of amounts and all of it. So for those small amounts, I keep mutual funds handy. And for big amounts, I'm doing the gold ones. It's very simple. कुछ नहीं करना है. Once you are getting there, एक बार you decide and do it. Got it? So all of you download this app at least today and start your registration.
Right.
Sanchari and
While all of
Rashmi.
you are doing that, I think I want to give my compliance disclaimer as well. So in no way am I recommending these products. What I'm saying is that these products are performing right at the top when you apply those particular two aspects of tracking error and also the cost, right, that is involved. So based on these two factors and the performance as of today, when we look at these funds, this is what comes on top for Nifty and also for gold. So I have to give this compliance disclosure simply because I am not allowed to give investment advice at a forum like this or even individually unless you are SEBI certified investment advisor, and therefore this. And again, we can do this as a project together. You can all get in touch with me one on one with all your questions. I'd love to run group sessions probably again on topics like mutual funds in depth itself, because we haven't gone there fully today. Everything was
Exactly.
more of a trailer for what is possible and what is out there in the investing universe. And there's lots to come in the exciting space. So watch out.
Rashmi, thank you so much for this. Sanchari, I'm thankful for this also. I want to get in touch with you, Rashmi, not for mine, but for my son's thing. See, I'll tell you
Education, higher
something.
education.
Not education. He is,
Okay.
see, 6 months or 1 year from now, he's going to get into a company, do his job and all that. He, I'll tell you, before even me telling, he's already downloaded this app. He's already started investing in the pocket money that he gets. So I'm really proud of this. He needs a bit of more education on this.
Got it. Got it. Got it.
Definitely,
So
I
for
would want
him
to
to
get in
build
touch
an
with.
investing plan for himself is what you're talking about. Understood.
Yes, yes.
Yes,
He knows
absolutely.
that he
Absolutely.
knows very what to say on a surface level.
Right,
So he needs
right,
to know
right.
it in depth as to what he could do it.
Wow.
Wonderful, wonderful. I'll be really happy to help you
Yeah,
through.
because we've never told him anything and he's done all on by himself. I'm really, really happy for that.
Right,
So based
right.
on his
I think
interest,
the
I think
only
I'll have to.
catch in this situation is the way you identify with me and trust me. I don't know if your son will do the same, right? So probably it's a discussion to have because a lot of these avenues and investment advice, etc., run a lot on trust and how much you can identify with my journey and what I have done. So probably if your son can trust me with this and we can work this together, I'll be very happy to help.
Definitely, definitely, Rashmi, no doubt about it because he knows. I think I'll definitely get in touch with you.
Yeah, sure, sure, Maitri. Thank you.
Thank you.
Thanks, Farzana. Okay, Juhi, you are asking a question. He's working in the US. Can he invest in India? Yes, of course, you can invest in India. You can invest in India as an NRI. A lot of NRIs do. NRI taxations are much attractive, much better. There are a lot of avenues which are being made attractive for the NRIs to bring back money to India as well. So yes, absolutely.
So
The
you
answer
can
is
also
yes.
help him. Like he's also started his just journey. He's just started his first job. So can
Right,
he just
right.
start
Yes, of course, of
investing
course,
and
of course.
saving?
This again depends on how much he wants to invest in India versus in the US as well, right? So of course, probably investing in US will be more convenient, but investing in India is more for the growth aspects and whatever reasons we are all convinced about the India growth story, right? Beyond US,
Mhm.
because this is a developing economy versus US being something more of a thing which has, it's not going to give as much brilliant and attractive growth like India. So it's also about
Yeah,
that,
but do
but
you
of course we
suggest
could.
he can buy a property in India if he starts saving now and a small like 50 lakhs or something if
Of
he
course, you can
invests?
start to plan for it. So for it, like I showed, if you do that goal-based investing sort of a thing, right? You can start to park your money in India for buying a property in India. That would work the best.
Mm.
And if you have that timeline, that helps you understand where to put how much.
Okay,
Yeah.
I'll get in touch with you.
Sure, sure, Juhi. Thank you. Right. I think there's a question on Angel One, Grow app. Are they similar? Yeah. I think it's a race to be more convenient and attract more and more people these days. So yeah, you can compare these apps as well and use. But Angel One is also not bad and it's pretty good. It's
Yeah,
just
so
that I ended up using Grow and talked about Grow, and also Sanchari showed us Grow. Grow doesn't pay us for this.
All of you guys, so now today we have got enough to start exploring. Nothing would make me and Rashmi happier if you send us a screenshot of your first investment after this. We are ready to take you through each step possible. तुम 100, 200, 300 एक स्टॉक खरीदो, कुछ भी एक छोटा स्टेप लो, and we are there. So you know the technical part and all is there for it. Rashmi, can you remind them once more how they can get in touch with you more if they want to get an audit or they want to talk more about this?
Yeah,
Can you share
absolutely,
information?
absolutely,
Yes, please.
Sanchari. So I'm available on Instagram at Rupee Smart Drive. You can DM me there and we can get in touch. Also, I've put that out on the chat box as well at Rupee Smart Drive. That's my ID on Instagram. Please DM me there and we can get in touch. Of course, all of you will have my WhatsApp numbers if you come through the WhatsApp communities, one-on-one through WhatsApp, etc. So that's an alternative as well. like Sanchari mentioned right at the start, and I've been saying, I do take one-on-one consultations. You get a free 30-minute discovery call with me for having attended this session as well. And you could take the conversations right from there if you like, and we can work together. Also, I'll be dropping in a feedback form for this session. Please fill up the feedback form, and we can also meet up on more group sessions, more in-depth group sessions. I'd like to understand from you what sort of resources you would want and what sort of resources you would like to see from me as well. Let me just drop the feedback form, and we can take it from
Guys,
there.
whenever it comes to money, there has to be, I've taught you enough, it has to be an exchange, there has to be a flow. Since you are working on money and Rashmi has spent the last so many hours telling you about this, talking about it, you guys have to return this energy so that it can start flowing. So please fill the feedback form.
Yeah, just coming up.
And by the way, just a gentle reminder that all of you who have our journal, all of you who have our abundance toolkits, all of these sections are available from page number 42. If you could see it, so you can start using these sections to fill in your journal now. Your big goal, small goal, what is your emergency funds, where should your money be? So now all of this will make much more sense. When we are on Soul Fest, Rashmi will be taking a very special session for you guys, as well as we are going to play a very fun game. Yes. So we're going to play a very fun game as well this time. And when you come to Soul Fest, we will be walking away as CEOs. So please take a minute to fill the feedback form also, guys. Okay. Any questions, any parting words, guys?
Let me take a minute to say thank you to every one of you who stayed all the way till the very end, right from the start. Thank you for your investment of time in me. I hope it's delivered good returns for the session and beyond. I hope I've at least opened up a window of new thoughts in your minds today, and you will chart this investing journey with me. And most welcome if you want to do it with me, and I will be even more happy if you do it by yourself. Thank you so much.
Thank you, Rashmi. Thank you, Sanchari.
Thank you all, guys. So I want to hear more from you guys when you
Thank you,
start
Rashmi. Thank you, Sanchari.
to make more money. Arigato, arigato to you. Thank you so much.
Thank you.
Arigato, everyone.
Yeah, and
Sanchari,
one
Rashmi,
thing,
special
two
one.
things.
Yeah.
Two things I forgot. I want to make an announcement. First is tomorrow at 2 p.m. we are having a session on sketchnoting. So make sure you are there. And we had missed taxation this week. So this time we were supposed to do taxation, but because there were already a lot of things being discussed. So let's plan another time this week where you can take taxation also, because it's March. People will need help on this.
Sure. We can run a quick 1 hour session on taxation.
Yeah,
Just
we'll
the basics, and again, like a trailer.
Yeah.
The recordings are available right after this only. I will share. It's available. I had done the YouTube one. So guys, watch it again and again and we'll take it from there.
Oh, that's very cool. Thank you.
Yeah, thank you, Rashmi. Thank you so much.
Thank you, Sanchari. Thank